Good evening, members. Today's speaker, Vaishaka Bhatt. My colleague in the committee is here, Divya, secretary, and my dear friends. I welcome you all for today's the last day session on transfer pricing. The major topics, last 2 days major topics were discussed. Today, two speakers, one is CA Vaishaka Bhatt and CA Narendra Jain. They are going to handle majorly topics covered on documentation, certificate, issues and precaution, COVID and transfer pricing related issues. With this, I welcome CA Vaishaka Bhatt for this session. Very warm welcome to you, madam.
Hello, sir. Thank you.
Very warm welcome to you. I request CAS Divya to give a brief introduction of the speaker. Over to you, Divya.
Very pleasant good evening to all the participants of today's program and to also our speaker of today's program. We're very delighted. We have Ms. Vaishaka Bhatt as our first session speaker. To give a brief introduction about her, she is a practicing chartered accountant with an overall experience of 12 years in area of direct taxation, including transfer pricing. She worked with E&Y from 2007 to 2018. During the experience in E&Y, she had worked on various tax and regulatory areas with specific focus on international taxation and transfer pricing matters. She currently handles project involving cross-border structuring, transfer pricing modeling, transfer pricing documentation, and many other areas in transfer pricing. She speaks on taxation in several forums, including Institute of Chartered Accountants of India. With this very brief introduction, I wholeheartedly welcome you, ma'am, for today's program. Hearty welcome to you once again.
Thank you so much, Ms. Divya, for that generous introduction. And thank you, Srinivasan sir, as well. And I thank, of course, the Bangalore SIRC branch for the invitation. So the topic, TP is essentially a substantial part of compliance as well as risk management for multinational companies with cross-border transactions. And therefore it's, we are all heading towards the compliance season, and, organizing this TP workshop at this time has been also very opportune and timely. It is TP as a practice area is evolving. We've spent, I think, quite a bit of years calling TP as a evolving and a nascent topic, but the truth remains that every day there is something new happening, and the area itself is developing and progressing both from a legal side and from an economic side, and therefore approaching a transfer pricing matter would require a little bit of economic bent of mind rather than a complete legalistic mind frame. So therefore with that, probably the thinking, the topic set for today is that we want to discuss some issues, practical issues and concerns that we will kind of face or have to be mindful of while doing the transfer pricing compliance. Today, while I go through my material, I presume that we are all having a little, all of us are familiar with the basics of the transfer pricing provisions, and we have some kind of a practical exposure. I am going to try and engage in a discussion wherein I will share my experience with you all, and very happy to hear either questions or feedback or your experience, because at the end of the day, TP is a very fact-specific exercise. Each person would have probably approached the same issue in different manner. So we will, at the end of the 2 hours, try and understand some of the common issues and errors that may have been done in the past, which has probably led to kind of a litigation or a difficulty in defending it at a higher level. Or considering the global improvements and the more and more knowledge and know-how we have about TP, what could be some of the commonly seen transactions that we could better present or improve our own approach or analysis to doing the TP documentation for those parts. So broadly, this is a basis with which I would want to go through my presentation. I will cover some of the basic provisions, and then I have some case studies which we could go through, wherein we will look at each of those specific fact pattern. I hope my screen is visible.
Visible,
presentation.
Yes, yes.
Yeah. Thank you. So a quick recap. I'm sure all of you are familiar with it. The provisions of TP are contained in section 92 to 92F. The primary requirement for it to apply are that there has to be 2 or more enterprises. The enterprises should qualify as associated enterprises. The enterprise should enter in transaction, and the transaction should qualify as an international transaction. There are certain provisions, there are certain exceptions where TP provisions would also apply to certain specific domestic transactions. Now, what happens if those 4 conditions are satisfied? Then the law tells us that if you have those 4 conditions satisfying, then as a taxpayer, you have to compute your income or claim allowance for expenses arising from those international transactions at arm's length price. So the arm's length price as a word, what essentially is a cornerstone for the entire TP regulations. We do the entire exercise or the activity is at the end of the day undertaken to ensure that the transaction that the taxpayer has entered into with its associated entity is at arm's length price. And the law tells us that when you have entered into such transactions with associated entities, you have to obtain and file a CA certificate in Form 3CB. Also maintain certain documentation in the prescribed format within the due date. If you don't do all this, there are certain prescribed penalty implications that are encoded within the regulations. One thing that the section also clarifies is that the objective of imputing transfer pricing is only to kind of add to the taxable income or taxable base of the taxpayer. If replacing the transfer price with arm's length price has the effect of reducing the taxable income, then in such instances, the law has very clearly said that TP provisions will not be applicable. So, we saw that there is a requirement to obtain and file a chartered accountant certificate. So what is that? It is in Form 3CB. I'm sure we're all familiar. Even if the taxpayer has entered into a rupee of international transaction, there is a requirement to file the 3CB. But what I want to pause here and kind of talk about is that I think a lot of us as practitioners do file, as just like how we would do several other reportings for tax purposes. This is also something that's routinely undertaken by many practitioners. But there are certain things that we have to observe here as to what we are essentially certifying under a 3CB. Number one, we are saying that we have looked at the international transactions that has been entered into by taxpayer, and the taxpayer has the necessary TP documentation to kind of defend this particular transaction, and that the price at which the transaction has been undertaken is at arm's length price, and we are further certifying that the value of the transaction is true and correct. It is not true and fair, it is true and correct, which means there is a higher level of threshold that we are certifying on when we give this certificate. The due date for giving the certificate is 1 month prior to the due date for filing the return of income. Where the transaction value exceeds 1 crore, the law also prescribes that there is a requirement to maintain transfer pricing documentation in a prescribed format. This documentation requirement is specified under Rule 10D. And then for the purpose of specified domestic transaction, the threshold given is 20 crores. I'm just for the benefit, of all, just quickly going through the provisions. We will, very soon get into the practical issues. Just as a refresher, I just wanted to set the context. So then what happens if you don't enter into, if the value of transaction is not 1 crore? The way the rule reads is, it doesn't mean that if you have a transaction less than 1 crore, that you don't need to kind of defend or substantiate whether it is at arm's length or not. The provisions of TP continues to apply. It's just that you don't have a requirement to maintain an elaborate documentation that is prescribed under a Rule 10D. So what the rule tells us that you have to have some kind of a material that would be used to substantiate that the transaction has been undertaken at arm's length price. The law also says that we have to maintain the documentation on a contemporaneous basis. Contemporaneous by meaning would be understood as that the data, the analysis that we do is as close as possible to the time period at which the taxpayer has entered into the transaction. But it also clarifies that if in case of a continuing transaction and that there is no substantial changes in the fact pattern or any kind of a circumstances revolving that transaction, then you don't need to maintain it. Then you don't need to maintain fresh documentation on a year-on-year basis. You could kind of rely on the earlier documentation itself. Again, the important point here is I don't have a requirement to submit a TP documentation, unlike a Form 3CB. But when I file the 3CB, I'm essentially saying that the documentation is being maintained as on the date of filing the 3CB. Also, the rules under TP documentation mentions that you have to maintain the documentation as of due date. So, which means you should essentially, if you are maintaining documentation, it has to meet the requirement of that due date. But the requirement itself to submit the documentation comes only when the TPO asks for it, and we will typically have 30 days to submit it on further request, on request, and another 30 days may be provided by the TPO. What are the consequences if we don't comply with some of the provisions? There are very, very steep penalty implications in certain instances. And this is precisely why the documentation and the reporting has taken so much importance and priority for both MNCs, the taxpayers and the practitioners. Starting with the penalty implications for wrong or non-disclosures, which is straight away a value of 2% of the value of international transaction. So, so what is international transaction? Of course, you would all be aware it is specified and it's prescribed under the Act under Section 92B, and it's a very, very broad list with an inclusive definition. So because of the penal implication of 2% of the value of transaction, every time we are faced with a question on whether this is a transaction, whether it's an international transaction, whether we need to report it or not, you are better off erring on the side of excessive reporting. You're better off reporting than not reporting, because if not reporting, basically the company or the taxpayer has to have the resource and wherewithal to fight or defend. If there was a question in terms of why this was not reported, I'm going to initiate a penalty proceeding. So to avoid that general disclosure, you would see that we would tend towards disclosing more than what is required. Of course, being mindful of what other repercussions or implications it could have. But as a general rule, in the transfer pricing arena, we would see that more the disclosure, which is better. Another reason why a disclosure is important is that the post-scrutiny adjustment. That is, let's say if there was an adjustment that happens during the assessment proceedings, there are two kinds of penal implications that is given, which is linked to the tax payable on the adjusted amount. Right? That penalty is 50% if it is mere underreporting, but that penalty goes up to 200% if it is because of misreporting. So, which means if I have a documentation wherein I've said this is a these are the which I advise, and from that there is a difference of opinion between you and the TPO, and there is an adjustment. Possibly the penalty is 50%, but for some reason, if you have missed to disclose, report, or kind of capture some very key information that was relevant to that transaction, there might be a case built against the taxpayer on the fact that it was a misreporting, and therefore the TPO, in addition to the tax adjustment, could also seek to do a penalty proceedings at 200%. So, what happens, in terms of practically how many of these penalty cases sustain, those are discussions, which we'll have to look at issue to issue. Do we have a legal basis for what we have done? So those remain. There are a lot of arguments in favor of the taxpayer in those cases. But the point I'm just trying to say here is that not all taxpayers have the ability to go fight till tribunal and high court and then establish why they have done something, and get a favorable ruling. There is still a cost associated with that litigation. So for those who are not willing to or not able to spend that kind of both cost, time, and resource in defending something, your documentation and your report should completely speak for itself, so that you avoid any kind of a frivolous discussion around that part. What does the rule mention or rule prescribes as a transfer pricing documentation requirement that is given under Rule 10D as we spoke? Of course, there is another documentation requirement, which is a master file for certain companies which cross a certain threshold. But we will restrict the discussion in this slide to the Rule 10D under the normal documentation, which is applicable if you have the transaction value exceeding 1 crore. So basically, I think all of us are familiar and aware of how a TP documentation is structured. We've seen that there is the initial part, which is a background and the overview, and then we have the industry overview. Then we have the FAR part, and then finally the economic analysis. That structure of the report has essentially evolved over a period of time, largely basis how global or Western countries were maintaining documentation at the time when India started to do the provisions. But if you see that each of those ingredients somewhere has a need and a relevance drawn from the listing of the information requirement that's coming from the rules itself. So what is the so therefore the first structure is where we would give an overview of the ownership structure, the profile of the group, description of the group, etc. And then the next section would talk about more in depth into the nature of the transaction itself. What is the terms in the agreement? What is the FAR that is being entered into between parties? And then we have the industry overview, where we would capture a simple write-up on the nature of on the statistics relating to the industry in which the taxpayer operates. And finally, there is an economic analysis part, which is where we would do the actual which is where we would do the actual analysis for how we are defending that it is at arm's length. So with that, brief background and context, let's go into some of the issues that I have at least come across, and I thought that we should be taking precautions or improve our own presentation and disclosures with respect to to those transactions. So one of the big question that generally gets asked is, when I have a loan transaction, should I disclose only the interest or should I disclose the loan part also? Why is this relevant? So what is the relevance for in generally the question around what should I disclose, right? So we'll take a step back and just understand that. Considering the penal implications, it was a no-brainer that, the more I disclose, the better it is. Because what am I losing? The transaction has been undertaken. It is reported in financial statements. It's going to be shown in the return of income. What am I really hiding by not showing certain transactions in 3CB? The cause for concern really was that even though so there are two things. One was the threshold applicability for TP documentation was set at such a low value of 1 crore. The second is, earlier the threshold for mandatory scrutiny for a TP case was internally within the tax department set at 15 crores. So there was a belief, fear and an understanding that if the transaction value you disclose in a 3CB exceeds 15 crore, it will mandatorily get picked up for scrutiny. Therefore, people were cautious and conscious of what they put into the 3CB so that it is not unnecessarily getting mandatorily pushed into the scrutiny stage. And this, again, the fear came from the fact that any case that got picked up for scrutiny, a general statistic suggested that 1 in every 2 cases picked up for scrutiny has really ended up in adjustment. And this was really the premise or the reasoning why we were all conscious or at least mindful of what we are putting in 3CB and what we are not putting in 3CB. So with that context, therefore, in a loan and an interest transaction, while the interest itself could be of low value, but the loan quantum would be very high. Therefore, whether I have to disclose it. If you look at the definition of international transaction, there is a clause which says it includes capital financing. So, and if you look at the general definition of international transaction also, it could say any transaction that has a bearing on, profit, loss, assets, etc. So, looking at the two clauses together, typically there is hardly, if you were to look at it in a more practical approach, I'm here for a minute not giving these viewpoints from a legalistic perspective. Again, because do I have the ability to fight this matter out in the High Court? If the answer to that is no, then we have to take some of the pragmatic approaches to ensure that both us as CAs, have done adequate disclosures, too, as the client also safeguarded from frivolous litigation. So now, if I have taken the loan during the current year, then I think it's safe to assume that it is a transaction as well. And therefore you should report that, and of course the interest payable on that is also separately disclosed. The general logic towards this is, while loan is a loan I've taken and interest is something that's payable on the loan, but the principles are today evolving to say that one could even, the TPO has to be given the opportunity to see even if whether the loan itself is an arm's length arrangement. When I say that, so there is a difference between saying whether the interest is arm's length and whether the loan itself is at arm's length. Now, if my loan was 100, then I paid 10% interest on that. Under the interest benchmarking, you check for the terms and conditions, quantum of loan, period of the loan, credit rating of the parties, etc. You will be defending whether 10% is correct or not. But who is to sit in judgment of whether the fact that you have obtained that 100 rupees loan from your AE itself is at arm's length? What do I mean by that? Maybe you are over leveraged, right? In a third party situation, if your balance sheet strength was so and so, you may not have gotten 100 rupees, you may have got only 50 rupees or 40 rupees. A prudent other prudent lender who's not a related party may not have given that loan to you. So therefore, it is kind of a necessity to establish that the fact that it is a loan arrangement and not equity in nature itself is a onus on the taxpayer to prove that. And therefore, an argument that it has to be separately disclosed. Second is, so once I disclose it in the year one, in the year in which I have taken the loan, should I disclose it year on year? There is no straightforward answer to this. What I would, as I said before, that you are better off disclosing than getting into the argument of whether this needs to be disclosed or not. But at the same time, being conscious that the moment I disclose it as a separate line item, I'm going to have to add and enhance my total value of international transaction unnecessarily, and that's going to lead to other repercussions. Example, your master file threshold is there. You might just have a 5 crores of interest payment, but a huge, more than 50 crores of loan. Just because you've shown that loan item as a separate line item, you might trigger the master file applicability, because it can't be a case where in 3CB you say my total value of transaction is 60 crores and then take a view that master file is not applicable. These are some of the practical issues I've seen, where the client believed I just have 5 crores of interest transaction and therefore master file should not apply. But somehow in the 3CB, the underlying loan amount was also disclosed, and the total value of transaction 3CB was disclosed. Now, once having myself kind of reported that there is more than 50 crores of transaction, it might be hard to take a view that master file is not applicable, even though technically I have no requirement to disclose the excessive level of information that is expected in the master file. So we have to be conscious of the total value that we disclose, but also be conscious of the downsides of not disclosing. So here, as a wire media, one could put the loan amount outstanding this is in the case where in the subsequent years, not the year in which loan has been borrowed. You could disclose it somewhere in the notes section or in the description section, saying, this is amount borrowed, outstanding amount as on this year is so and so. Therefore, you have both disclosed it as well as not added it for the purpose of the total value of transaction. Similar with share capital, after Vodafone, Shell, and there was a CBDT instruction that said that don't pursue transactions, which went as an instruction to the tax officer saying don't apply transfer pricing to share capital transactions and impute an income. But again, going by the definition of international transaction and the explanation, nowhere there is a way out for you, or nowhere it kind of suggests that it's not an international transaction. It's just that you don't have to do an income adjustment to that transaction, right? So from that perspective, again, and I've had a case where it didn't lead to any kind of an adjustment because it's really absurd. But the TPO actually told that all that the CBDT instruction said is TP is not applicable. It didn't say it's not an international transaction. In 3CB, you're supposed to disclose all international transactions, but you have not disclosed. I'm going to initiate penalty proceedings. Somehow we were able to convince the officer in that matter not to initiate. And if they did, this quantum was really big, right? Because there is a share capital issuance, the quantum is big, and 2% of that is really big. So you really don't want to get into those issues and discussions. So if there was an possibility, you just disclose the transaction. Then comes how to compute the total value of transaction. So this is I think the point I already alluded to. Obviously, you would just total up all the line items that we put and disclose in the 3CB, but the total value has certain repercussions. One being the master file, like we discussed. The second being that value also is an indication for the department to see how sizable or not sizable your case is, and therefore becomes a determinative factor even after scrapping the 15 crore threshold. Currently, for the TP audits, the department follows what is called a risk-based assessment. But even after that, the size 15 crore is one of the possible risk assessment factors. Therefore, the total value that we show in 3CB will have a The last point here that I just thought I should just leave it there is that this is again a case that I generally situation I have seen, that typically for a captive entity who are having a billing model of a cost plus markup, especially in cases where TP documentation is not maintained, but only a 3CV is filed, some of us, choose CPM as the most appropriate method. That is actually not correct, because there is a difference between the billing model of cost plus method and the transfer pricing method of cost plus method. The cost plus method under the transfer pricing rule is specifically prescribed as to how you have to compute, and typically the checkpoint there or the testing there happens at a gross profit level. So I have to see the direct cost relating to the transaction and then the profit margin on that. The limitation is that I will not get that same data of the gross profit for comparable companies. So technically, when I do a comparability analysis, what I'm applying is TNMM and not CPM. Therefore, it might be sort of good that in 3CV also we don't report it as CPM, because once you've selected a method in the 3CV, it's very hard to, at a later stage of disputed, fight against that method. So let's, in a situation where in 3CV we have said CPM and they've not maintained documentation, possibly on the basis that, I will do documentation if and when the tax officer asks for it. And then imagine the task for the person who was later on appointed to do the TP documentation. It might become hard to justify the CPM. It might become harder to say why that method is therefore not appropriate, and therefore I do a different method in the TP documentation. So the choice of method in the 3CB has to have a basis and a clear understanding in terms of how exactly I'm going to apply that method. Moving to some of the disclosure issues in the TP documentation. 10D has a very long list of requirements. We saw it, in this slide. The question is whether every transaction, every taxpayer has to disclose each and every one of these line items. Typically, and why am I saying that is that, because we don't do the TP documentation based on what the rule requires or what the transaction requires. Conventionally, we start with the TP documentation format and try to force fit the transactions that we are evaluating into that format, because of which sometimes, there's kind of a disconnect. So the simple answer to this question is, you need to disclose all transactions that are relevant, all information that is relevant to your transaction. So what that means is that's really a judgment call. So let's take an example. There is one line item which says records of budgets, forecasts, financial estimates. Now, so this is a requirement that is given under Rule 10D, but we really don't show the future estimates or future budget for a captive entity, because it is not relevant, right? For a captive entity which is getting remunerated on a cost plus basis, need not necessarily show what my future is looking like, because whatever is my cost in the future, even that would get kind of remunerated by my AE. Whereas if you look at a risk-bearing entity, whether it's a manufacturer or a distributor or a service provider, and let's say there is a fluctuating margin in that entity, then in some cases, you would do better to kind of showcase that this was my budget, or this is my estimate for the next 3 to 5 years. So even though there is slightly lower margin or a loss in this year, it's really business and economic circumstances, and I expect to break even in so and so year, and I'll have a profitability in the subsequent years. That information captured in this year would kind of strengthen your TP documentation a lot more, and also establish the fact that the taxpayer is really an entrepreneur. Again, a caution point, it's not just because I'm saying that, it's not that we just take some business plan and put it in the documentation. Because if it is not really robust, what happens is in a year on year, you will essentially have to again kind of go and define that numbers which you have shown as projections or your future estimate. So only in cases where it's required, where so I have personally used it in cases where it was such a situation that the Indian entity has incurred losses and no other method was suitable, or information was not available, or client was not comfortable sharing the data either under a cup or some other method, that we were forced to use TNMM at an entity level and still justify the international transaction even though the tested party was at a loss. So even such, those situations also happens. In that case, what we have to do is see the comparables have made a 5% margin, but I have a loss of 10%. I'm still concluding that the international transaction entered into by the taxpayer is at arm's length, because the reason for loss is not the international transaction but something else, and I have to explain that something else. Maybe because I've incurred excessive business development expenditure in the current year, or there is a huge fixed cost that has been incurred which I have not kind of fully absorbed. So some of these, and if possible, you also make other economic adjustment. But in a situation where you're not able to do it and there's no other adjustment possible, you still are giving a documentation with a net margin analysis, with a loss making, at least show the future profitability to say, this is why I have loss in this year. Here is my future estimate, and at the end of year 2 or year 3, I will have a profitability, and this is the basis which I'm defending that pricing is at arm's length. Second point is on whether there is if the threshold of 1 crore is exceeded purely because of a receivable item. So what do I mean by that? Let's say it's a very small company, export-oriented company. I provide or a startup company. I provide services to my associated entity. Value of that transaction is 60 lakhs. Somehow, because of cash flow constraint, that entire 60 lakhs is remained outstanding as of year end. So in my RPT schedule, there's a transaction value 60 lakhs, a receivable value outstanding, which is another 60 lakhs. What should I do? 60 plus 60 is 1.2 crores. So should I maintain documentation? Should I not maintain documentation? Standalone, there is a lot of merits in saying that receivable is just the receivable part is an international transaction, because similar to what we discussed in the loan part, the taxpayer is supposed to also establish that the terms of the credit period I've offered to the AE is also at arm's length. It's not just the price. It's not cost plus 15 is adequate or not is not the only point of debate. The fact that I've allowed it to be, kind of outstanding for more than 12 months, is that also arm's length? Is taxpayers onus to establish and defend? Because in a third party situation, it is very clear. If you go and pay cash and buy something, there is one price. But if you buy it on credit, the price is obviously going to be higher, because there is an interest component that is embedded in that pricing. So there will not be entirely an economics merit to say that it is the same sale transaction which I have disclosed, which is outstanding. Therefore, why should I disclose it twice? Having said that, sometimes for the smaller companies, it becomes a burden. Just because of this, I'm exceeding the threshold. Should I maintain the entire documentation? The via media, there is, please report both. We can report both receivable and the transaction in 3CB, and maintain a simplified documentation. Assuming the client is going to be at this level of transaction for year, 2 to 3 years, maybe you take the benefit of the rollover of the same documentation and say that, and every year you can continue to say that, this is a transaction. This is why I don't believe that I need to maintain TP documentation. but I've still maintained out of caution. For this purpose, I've relied on the last year documentation, something like that, which the company in its letterhead kind of puts it together and somebody authorized signs it, and you date it as of the due date for maintaining the documentation and call that a documentation and keep on records. Industry overview. So again, it's part of the format, part of the standard template that we have for TP report. So we kind of fill that up with whatever information we find, which is fine. Most of the times there is no relevance to what we capture in the industry overview and the transaction that we are kind of evaluating, because not always, especially when it's for a captive or a low risk entity that we are doing the TP documentation for, the industry really does not play an entire role. But only caution point here is, let's say you have a, I had a chance to, I had an occasion to do again an assessment for one client wherein we had not done the TP documentation, but the assessment was handled by us. That time it was a automotive component company, and the defense in the TP documentation was something similar to what I was alluding to before, that they had a very low margin, and the conclusion in the TP documentation was that the company has faced a lot of market resistance, the sales have been slow, the business has been slow, industry has been impacted because of XYZ reason, and therefore there is a low margin. Looking at it futuristically, we would improve margin in 2 or 3 years. So the conclusion drawn was something of that nature. In the same report, the industry overview captured a very rosy picture of the industry. They said this we have the industry itself has boomed, has a substantial export market. It has done exceedingly well because of XYZ government initiatives, and the future outlook is also looking very, very good. So the simple question the TPO asked is, it's kind of contrary. There is always a reasoning, right? Industry overview we give for the broader industry, but still there will be individual players who might be impacted because of the industry to which they supply. So what do I mean by that? Mine was a case. So auto as a whole probably has done well when you look at it at an industry level, but my client was supplying equipments or the components or the finished goods to mining industry. During that year, their customers or clientele are primarily from mining industry. Even though auto has done well, mining had not done well in that year, and because of which these guys had suffered a setback. So if this picture, right, if this explanation was brought in the industry overview, this was a very easy explanation to give, and anybody who is a prudent businessman would understand this. But this mismatch led to kind of questioning and a mistrust from the transfer pricing officer, that we had to jump additional hoops to explain and defend our case. The next point is capturing the risk profile and the entity characterization. So there is always a, in the FAR part, we tell what all the Indian entity does and what is we conclude with the risk characterization. Finally, we also give one characterization, limited risk service provider, insignificant risk service provider, or a limited risk distributor, a normal distributor. So we are used to these terms, but the only point of caution is, let's again be very careful on what we are saying. And what we are saying, of course, has to flow out from what the actual facts is. Sometimes the facts is not just looking at the current year, but it is also looking at the future and the past year. Let's take a classic example. A software service provider has, let's say it's entirely export, but he has 2 to 3 AE customers. Okay. The cost plus is a method that has been is a billing method, and they do TNMM and justify why the margin is at arm's length. Now, because I have 2 to 3 customers and everything, when it's all going well, nobody has a problem. Margins have been very good. So the TP documentation captures that all the Indian entity does not bear any risk. Everything is borne only by the AE. Therefore, it's a completely limited risk service provider. In a year, something goes wrong, right? If business has been hit or there has been some kind of a problem wherein the capacity of the Indian company is not entirely utilized. So there now the AE is telling, there are 2 to 3 AEs. AE is telling, I undertook to give cost plus markup on the work that I gave you, on the cost you have incurred in delivering for my project, not if there was no project. So therefore, what essentially happened is the risk of capacity utilized. So there was a period where the people were not entirely utilized. That cost was not recovered because none of the group entity was taking responsibility. They've all been compensating only for the project that they have given. Now, how do I look at this now in an economic sense, right? Like whether it is even correct? Can the AE say that? That really depends on the facts. When I say facts, we have to understand, dig little bit deeper in terms of who does the hiring, training, budgeting, etc. for these people count, right? If in the beginning of the year, each of the AEs have said that, during this year, this is the kind of project I will give you, and this is the headcount that you have to maintain, you just go higher. If somebody says this, then the AE is responsible to pick up that cost in entirety, whether they were able to give the projects or not. But if the hiring decision was entirely with the Indian entity to say that, these are the expected projects that I have, instead of, maybe doing a subcontract model, I will keep 20% in bench, I'll keep 10% in bench. If that decision was purely made from an Indian entity perspective, then the risk of capacity utilization is with India. Now, in many circumstances, we don't even engage if we don't engage in this conversation with the client, we wouldn't know who is bearing the risk. Margin looks healthy, therefore everything is okay. We just conclude probably that the India entity is not bearing risk. Now, once we do that, in a year where you want to take the defense of a capacity utilization risk is borne by India, then you will have that difficulty, because year on year you've been saying that risk is not there with India, but in the year when you want to make an adjustment or showcase a lower margin, we are taking this argument. So it's one of the examples. The point, therefore, is to ensure that any risk characterization or profile that I say has to be futuristic, and it has to be consistent for the tax authority to trust the taxpayers' documentation and the approach. Nowadays, again, master file is another critical input. Whether we like it or not, gone are the days where we could look at TP as one-sided analysis. We have to be mindful of what all information is getting disclosed by the group in different places, and master file is one such very significant document. All the disclosures in terms of characterization, nature of transaction, intangible ownerships, financing arrangements, everything, any kind of a defense or an analysis that we do for India documentation has to be aligned with what the master file is saying. It doesn't mean that master file is always correct. We've had instances where we've had to go back to the client and gotten them to change the master file because we know what the India transaction is or India characterization is, that we know this is correct. Therefore, we go back and tell them, please change your master file disclosure because there is kind of a mismatch. But if the client has master file applicability, we should always take a copy of that, ensure we go through that and ensure that there is alignment in the India TP documentation. Alignment should be with all documentation. It's not just the master file. So the agreement, invoices, any other intercompany understanding, etc. So another, if I have to share another example, there was a case where we had to, it was a case where the company had paid a management fee, heavy management fee to the foreign company. the TPO disallowed it, saying that whatever benefit test was not proved, etc. And in that case, in the past years, they have not paid any management fee because the Indian company had a loss-making situation. In the year they turned profitability, they just made the payment. And how was this cost determined? Adequate, robust documentation was not there. There was a lump sum fee determined and just paid. And then the TPO has gone into fact finding mode in terms of you show me the agreement, show me the invoice, you show me what is the benefit, what is the service you've got, etc., etc. Only to notice that the invoice for this management fee has been raised in September, right? September after the close of the year. So let's say it's for March. March 21 is the year, right? Now, so for 21, before audit closure, I have raised an invoice and shown that as part of the March book. Something they've done like that, right? It essentially gave an indication that it was kind of a post-mortem. How they even managed to account it, or maybe they would, I have no idea, but the documentation clearly showed that it was post-mortem thinking. And the TPO caught on to that and was saying that you've really done this to siphon off profits after you've kind of closed the books and noticed that you have excess profitability and you've decided to make a payment. So moving on, just sorry, 1 minute. The other common mistake, again, this is an outcome of doing a one-sided analysis. Whether it's an import transaction, export transaction, whatever is a transaction, please don't show show it like you're defending only the Indian company. So in other words, what I'm saying is the comparable margin is 15%. India has made 20%, which is more than 15%. Therefore, Indian companies at arm's length. When you create a documentation like that, you are essentially saying the foreign AE is not at arm's length, right? So TP is a two-sided analysis always. Whether we are doing for the other company AE or not, you are creating a documentation for the group. So always ensure that we come to an arm's length range which supports both the entities. So, I mean, when I say that, I'm not saying that create an arm's length pricing which supports both entities. Be mindful of that. Typically, it's like ensure that the transfer price is within the range, within the arm's length range. If it is not, there are instances where even I have kind of faced that it will not come within the range. It will be more than the the higher end of the range. In those cases, be sure to write the reasoning for that. Mostly, if you land up in a situation like that, it means you have chosen the wrong tested party. But for many instances, we will have to choose like that from a practical perspective. In that case, where it is higher than the higher end of the range, then we have to make a mention of why it is outside of the range. It only indicates that the supernormal profits or the super profits from that transaction is vesting with the tested party because of the risk and the risk that is taken by the entity. Another point is sometimes we kind of decide that for a transaction, one method is good and just go select that method as the appropriate method. You might reject the other method, and we will look at an example for this when we go forward. But where you believe for a transaction more than one method is good, rather than rejecting that method, rather than going in hierarchy, cup, this is not relevant because not applicable because of XYZ reason, CPM for XYZ reason. Instead of doing that, you kind of explain all the methods and say for this transaction, cup, CPM and TNMM, all three are a relevant method for analysis. However, we have rejected cup for the following reasons. We have rejected CPM for the following reasons. And we have taken TNMM as the appropriate method. Why am I saying this? That in certain instances, even though your choice of method for your TP documentation is TNMM, at some point, if it is questioned, if it is litigated, taxpayer will have the ability to resort to the other method, right? And kind of provide an alternative analysis at the assessment stage or thereafter. So if on the contrary, if in the documentation you just say cup is not at all the appropriate method, then it becomes, there's one more hoop that the taxpayer has to jump to say your own documentation says cup is not the right method, then why do you want to apply it now? That becomes that much more harder to explain, and then go and submit a cup analysis. Use of PSM is getting increased attention, and globally at least is getting a better traction. Some of the, in India at least, I think freight, courier and these courier companies, freight companies have somewhere, it's more or less settled that they use the profit split method as the appropriate method, and several tribunals have also upheld it. In my personal experience, I've noticed that PSM works as a good method for startup companies because they don't have profits, right? Most of the times, the startup companies, they would either they would set their TP model in a way that they would kind of remunerate the India entity on a cost plus basis. If that be the case, no problem. But if that is not the case, and if the overall group size is small, it just is present in 2 or 3 jurisdictions, and there is an overall margin which is lower, or it's a loss-making company, you could just do a profit split method and disclose the overall global profitability. And because see, the risk is that, like, let's say the Indian company has made 12% and the tax authority wants 20%, right? The risk comes only when you give a one-sided analysis. If you say Indian company has done 12% and my global profitability is 8%, and here is why India has got 12% because of functional risk analysis, value contribution, all that you would show in the report. If the TPO is disagreeing with that, all that he could do is only move some of the profits from the other location to India entity. He can't go from 12 to 20, right? So the extent of adjustment cannot exceed what real profits I have made. Therefore, sometimes in some cases, PSM is a good method. At least use it as a corroborative method where the facts or the situation permits us to do, so that, obviously it shouldn't lead to an excessive disclosure and excessive information sharing with the tax authority. Generally, choice of cup versus other method. Cup envisages that a transaction has actually taken place. That is, a comparable uncontrolled price actually exists in the public domain within a particular period for which I'm doing the testing for the transaction. Other method presumes what could have been a price that may have been adopted between two unrelated parties. So the two are kind of different. It's not interchangeable. So every time when we look for a reimbursement or a recovery transaction, if you have an exact match back-to-back third-party invoice, then you put that reimbursement or recovery transaction as a CUP method. But if it is only a general allocation of that cost between the associated entities that is getting kind of attributed to the tested party, then CUP may not be the right method. Other method is right, because there we are saying that the overall total cost is something, and out of that, because India has also benefited from it, a part of the cost is allocated to India, and we believe the cost allocation fee is reasonable, and therefore it is other method. A caution also needs to be established in generally characterizing any transaction. When I say characterizing, the nature of service itself, for somebody who's not a technology specialist, software, somewhere all the transactions which is in the technology field might look similar, but it is important to correctly categorize them and be consistent about it, because that itself has resulted in several controversies and litigation. You might have said that I'm doing software and done software search, but the TPO disagrees with that and says it is engineering services. The set of comparables and the range of accepted markup could be different for the two. And at the end of it, it's also the pain of going through that litigation and, first establishing that my services are X and not Y itself is it's a difficult thing. So, and why would the TPO have the contrary view? Mainly when there is a contrary disclosures, right? So let's say your agreement says one thing, TP report says one thing, financial statements disclosure says something, website says something else. We'll have to avoid all that and ensure there is a common kind of a story written out everywhere. Yeah, that was on the characterization. Management fee. So typically I've seen that the quantum of payment of management fee will be very minuscule when compared to the overall size of the operations. And when that happens, and when we do the defense at a net margin level, it is kind of skewed, right? The methodology itself it's not right. You have to TNMM or the profitability might have been impacted due to several factors, and not just establishing net profitability does not by itself mean that the management fees is at arm's length. Having said that, how else do I, substantiate? Because it's one of the very hardest transaction to actually benchmark, and rightly so. Because of that only there's so many controversy also is coming, that you prove that you've actually received services, you've benefited from it, etc. In one of the cases, what we did is, and at least the facts also supported in that case, that entity, that group had a centralized entity where most of the management folks were there, and from that central entity, management fees was recharged to several other group entities. They had applied TNMM in the TP report, and that it sort of was not really making sense. When I say not making sense, to give a perspective, let's say if the management fee payment is 1 crore, the rest of the operations, the revenue from third parties was let's say 25 crores, right? And everything else is a third party operations. There's no other international transaction. So to justify this 1 crore, if I do a TNMM at the entity level, it really doesn't kind of, the movement, it does not really establish that the management fee has been correct or not. So in that case, at least at the tribunal level, what we try to do is to get a overseas cost auditor to certify that the amount of cost that is recharged to India from that US company and the basis of allocation that was used is correct and reasonable, and therefore one does not have to dispute that quantum, and basis which the tribunal kind of agreed the amount of management fee that was charged. So this is something that we could look at doing even at the stage of documentation, so that the client doesn't have to go to the level of tribunal to get a relief on this matter. Royalty also the similar issue. I pay a royalty which is like one item in my P&L, whereas I might have a larger operations and the profitability could be impacted because of several other factors. So what should I do? Most often, our choice of method is determined based on the accessibility to certain databases. To the extent possible, we should avoid it. Of course, it's a practical consideration. I'm not denying it. But in such cases, what you should do is at least get the royalty analysis. So what is royalty analysis? Basically, under a cup or another method, kind of pull out comparable uncontrolled agreements on royalty, compare with other third-party agreements, and say whether the 5% on sales I've charged or 6% I've charged on sales is correct or not on an independent basis without looking at the net margin. But this requires like a foreign database. Not everybody has access to it. So, but it is up to us to sensitize the client that this is a requirement. You have to justify your royalty on a standalone basis and not club it with the rest of the transaction at the net margin level. What you could do is essentially suggest that as a one-time exercise, because as long as my royalty agreement is in is subsisting, if I do it once, then the same analysis can be used on a year-on-year basis. The argument or the question exists whether it needs to be when the rule says documentation has to be contemporaneous, whether it needs to be updated on a year-on-year basis. A general understanding would say that at least don't, if you do a royalty study, you do it for year one. For the next 3 to 4 years, you use the same royalty study, and then maybe update it again, 3 or 4 years later. At least, that is better than doing only a TNMM analysis. Let's say if you're not even able to do that, then the alternative of what I had suggested before, that I have chosen TNMM, but CUP and other method is also relevant for this transaction. But we have not gone ahead with those methods because of lack of data availability, etc. The taxpayer may, reserve the right to present alternate analysis if required. Therefore, you're not closing the door for the taxpayer on doing the royalty analysis should this be questioned at a later stage. Interest-free loan obtained from foreign AEs. So this is a situation where, let's say there's a foreign company and it has a subsidiary in India, and the foreign AE has given a loan to the Indian subsidiary at a free of interest-free basis. The question is whether it is fine. More often than not, we tend to take a view that it is lesser payment only, therefore it should be fine from a TP perspective. So had I had the interest being charged, Indian company would have had to pay the interest, and that would have resulted in a lower tax base. So not paying an interest is not detrimental to India, and therefore it is fine from a TP perspective. So this issue came up. For discussion in the case of Instrumentarium Corporation, wherein there was a foreign company which has given interest-free loan to its subsidiary, and the subsidiary was kind of loss-making or had, carry forward of losses. It had defended, saying that had I paid interest, there would have been a base erosion, and TP provisions do not apply to base erosion. And therefore, not charging interest is at arm's length. This assessment happened in the hands of the overseas entity. Tax officer's contention is that the base erosion is not, it's not to be seen holistically. The law works assessee to assessee. So I will apply TP principles, qua taxpayer, not qua transaction. So when I'm assessing the foreign company as a assessee, then he has, by giving the loan at zero interest, he has not received any interest. Had he received it, he would have offered it to tax at whatever tax rate, considering the domestic provisions as well as double taxation avoidance agreement. Therefore, they went ahead and made an adjustment in the hands of the overseas entity. And this was also upheld by the tribunal, the special bench of the Calcutta Tribunal. Of course, this case is now currently pending appeal at the Calcutta High Court, and there are several reasons why the decision is, it's not a sound decision, but, or rather, there are a lot of arguments against this decision, but purely based on how the provisions stand today and how the assessment happens, in a sense, the principles coming from this decision is correct. So all that they are saying is, yes, when I look at India, had you paid, you would have, gotten a tax expense deduction of 34%, but had I, the income would have gotten taxed only at 10% or so. But that shouldn't stop me from deciding whether an arm's length price should be charged or not. I will look at it individually as a taxpayer. Here, as the foreign company, you have not, even though you were entitled to receive an interest which would have been taxed at 10%, you have not done it. So I am going to do an upward adjustment. Obviously, the law doesn't permit automatic corresponding credit or expense reduction to the Indian company. So that is where essentially a double taxation would happen. So why am I saying this right now is that don't accept positions of the clients that no payment means better from a TP perspective. You will have to look at it holistically. There might be an economic circumstance leading to why that loan at a free of cost is justified. You bring those justification factors in the documentation. Maybe that loan is in the nature of quasi-equity and therefore you have not charged interest. So bring those arguments in the documentation and maintain that documentation, say why a zero interest is also at arm's length, which is, or alternatively suggest to the client that you're going to have a very big risk if you don't charge the interest. You're better off charging the interest, get an expense reduction from India and offer the overseas income in India. That way we are only talking about a valuation difference. If you have charged 8%, depending on who gets picked up, somebody could say 9 is correct or 7 is correct. But nevertheless, there will not be a substantial difference. The other common issue I've also noticed is typically MNCs have the structure wherein Indian companies appointed as a marketing service provider. Happens more in a case where the overseas company has not yet fully penetrated the Indian market for its products, but is still in the exploratory stage, or has a very low volume of sales from the Indian market, that it doesn't see that there is a business rationale for setting up the plant or a full-fledged distributor to kind of maintain inventory and do the sales. So what they do is they have the Indian company act as a liaison office or a marketing office, and keep scouting clients, and if there is any interest, you just connect me to them, and we will do the foreign company will do the direct sales. For the marketing office efforts, there is a cost plus markup given. Now there are two problems in this. One is what is actually happening on the ground versus the theory that they say that they've done. Second is there is a PE risk, right? Or rather, a potential PE risk. If there is a Indian company is acting like an agent where he is kind of concluding the contracts on behalf of the overseas entity, then that would expose a foreign company to a PE risk. Therefore, when we characterize a marketing services TP report or the TP services provider company, whether in the agreement or in the TP report, we also have to be conscious of the fact that some of the languages that we would put there would potentially expose a foreign company to a P risk. Therefore, be very careful in terms of what description we give for this entity at the India level. And where that description is actually the fact pattern and there is actually a substantial involvement of the local entity in the sales, then the client has to be highlighted of the fact that you can't be a marketing office anymore. You have to convert yourself into a distributor. Otherwise, there is a risk of permanent establishment and 40% taxation vis-a-vis a 30% tax, 25% taxation. The last point is on last point here in this slide is on the choice of tested party. Again, we are all aware of the principles that the choice of tested party should depend on who's the most least complex entity, and on the entity make the adjustment. But more often than not, we choose the tested party again based on convenience and based on our own. So the same argument that I told for royalty would hold good. That way you think a foreign tested party would give a better results. Just do that, once in a while and use that report, which may be slightly expensive and you might have to approach somebody else for that analysis, but do that and then kind of rely on it for next 3 to 4 years while you continue to do the analysis based on India, in treating India as a tested party. So before I just move into case studies, I'll just pause here to see if you all have any questions. I don't see anything on the tab, but are there any questions?
I don't see any question. Do you have any question in your chat box? Please see.
No, it's not there. That's why I was just waiting. So the participants can't speak, right? They don't have... Okay. Okay, sure. So I'll proceed, and if you all have any questions, you could just put it in the chat box.
Please, ma'am, you can proceed with next topic. Yeah.
Sure. So the first case study is I've tried to kind of establish what is the need for doing a robust analysis, in the absence of which there would be the consequences, would be kind of unintended. So let's see that with this example. So we have a fact where a B Inc., which is a foreign company, holds 27% equity shares in A Limited, which is an Indian company. So because the holding is more than 26%, they become associated entities. We are told that the B Inc. provides know-how to A Limited, for which A Limited pays a royalty, and that royalty has been determined at 10 million. Now A Limited, when it pays the royalty, it's deducted taxes and remitted the balance. In such a fact pattern, let's see how their tax return is looking like. I'll start with the B Inc. column. It's a royalty income. In the absence of PE, that income is taxed on a gross basis. So the B Inc. in India will file a return saying I've received 10 lakhs income, which is subject to tax in India based on source taxation rules. TDS has already been withheld. and therefore no further taxes has to be paid. Right? A Limited will show its other profits and then claim a deduction of this royalty expense. The net profits has been determined, and A Limited, we are told, is eligible for a tax holiday. Therefore, will claim the tax holiday for that profits and has come to a taxable profits of 0, and therefore no tax has been paid by A Limited. Now this case has been picked up for scrutiny, and the AO, based on the TPO's report, has said that the ALP of the royalty should not have been 10 million, but it should have been 4 million. So essentially, he is estimating the arm's length price of the royalty to be 4 million, which means I'll give you deduction only for 4 million. This is in the hands of the A Limited. So what that would do to A Limited is the profits, as recorded before, royalty was 300 million. He'll only get the deduction for 4 million, and then there is a net profits of 296. Tax holiday will be restricted to what was claimed in the return, just because there was an adjustment. The law does not permit, and that's what the section says, that in case there is an increase, there is not going to be a benefit of tax holiday on that, and therefore post assessment there will be a tax on the 6 million. But what is happening to B Inc. is already offered 10 million to tax. So just because there is a reduction in the hands of A Limited, there is no provisions to correspondingly reduce it in the hands of the B Inc. On the contrary, there is an alternative provision which says that no such reduction will happen. Therefore, B Inc. will continue to pay taxes on 10 million. So this would be the repercussion if we don't determine this royalty expense correctly. And why did I take this example is, again, going back to the TNMM and other method analysis. This typically happens in a situation where we would have established the profitability at the entity level, and we have not independently established that the royalty standalone is correct. If we have done that using a cup analysis or other method, I'm not saying that in such instances adjustments have not been made by the tax authority, but it is you could avoid many instances where such an adjustment is made. Just a side note and some interesting decisions on this while we are at this case study. So the 6 million is not eligible for tax holiday in this instance when the upward adjustment is happening because of the assessment proceedings, but there have been decisions which have allowed the tax holiday when the upward adjustment has been made on a voluntary basis, or is as a result of agreement under a APA. Also, the reduction of this TDS has been a recent decision which is actually very interesting, that let's say when this assessment has happened for A Limited and the reduction, AO has reduced the ALP, and let's say A Limited in that case went for the advance pricing agreement and concluded on some price which was acceptable to both the CBDT and the taxpayer. One of the precondition in that agreement is that, here A Limited has already paid 10 million, and let's say in the APA, unilateral APA, they agree that it should not be 10, but it should not be 4 also. Let's agree that it will be 8 million, right? So what that means is India is going to give a deduction for the 8 million, but the precondition in the APA is that B Inc. will actually remit the money back into India. So today it has received 10 million, but one of the preconditions in the APA for it to work is that A Limited will recover the 2 million balance back. Now, when that happened and they had concluded the APA on that basis, B Inc. for some other matter was before the tribunal for the same year. And being, interestingly took an additional ground and said that, see, I have got this income, and this issue was not in dispute for being, but was in tribunal for some other matter. But took that argument that, I had offered 10 million to tax, but because of what happened to A Limited, I had to return 2 million back. So currently I have only 8 million as income. I want you to give me a refund of that also. In that case, even though there are actually no mechanism available under the law to do it, the tribunal accepted this argument and said that amount tax has to be refunded up to the 2 million, which has been refunded by P Inc. But having said that, that was a one-off case, and a case especially because being was somehow already in the tribunal during this time. If it was not disputed, and this happens essentially several years after we file the return, because the scrutiny goes through and then you go to the appellate levels and get this thing. By then, being the time limit for being to file any kind of a revised return is generally over. So question still remains, what would be the mechanism available to being to go and get this sorted? Case study 3, here I just again want to, we come to the takeaway. So we'll just look at the facts quickly. We are told that two groups, XYZ and PQR, both the companies have a wholly owned subsidiary in India, which is XYZ India and PQR India. In the first case, we are told the XYZ, so we assume here XYZ and PQR are foreign companies. In case 1, we are told XYZ owns the IP for some, eye drops, which is called Fresh Drops. And then it avails the services of XYZ India for marketing, promoting, and selling the products in India. So which means the foreign company which owns the IP to the product is kind of engaging XYZ India for promoting, marketing, and selling the products in India, which presumes that it is for XYZ India is a new market, and XYZ India is going to be doing the whole marketing and promotion. And then we are told XYZ India is responsible for the marketing strategy, budgets, promotion, and materials on behalf of XYZ. This gives the indication that, how do I strategize sale of this product for the Indian market? What should be the budget for advertisement? What kind of promotion material will work well for Indian market? All that decision and the expenditure is taken care by the Indian company. And we have the case too, wherein we are told PQR, which is a foreign company, has some cancer product, and that company is also looking to appoint its Indian company, which is PQR India, for marketing and selling the product. In this case, we are told PQR develops strategy for penetrating in the market. Therefore, it would be responsible for the strategic decision making for its product. PQR India executes strategy for marketing and selling the product. So here we are told how to approach this new market, what will you go tell, how do you advertise, all that I will tell you. You just go and execute my marketing plan and selling plan. Why did I take this is, if you see both XYZ India and PQR India are appointed as distributors for certain products owned by their foreign parent. In both cases, the product is new to India and they want the Indian company to market, promote, and sell their products in India. But depending on the functional profile, the characterization of the entity could differ, which could thereafter lead to a differential TP methodology that we would look at. So if I look at the case of XYZ India, here they say XYZ India will take the call or the decision in terms of how best to approach the Indian market, right? So any expense which is below the expense which is below the trading account is on XYZ India. What kind of advertisement do I place? Where all do I go and do promotional activities? Who will I, kind of, do I need a brand ambassador or not? Where do I go? How do I promote? My entire strategy is decided by XYZ India, depending on the India requirement. Any kind of a learning or a know-how that is available with XYZ India, while with XYZ, which they would have used in other markets, while it may be useful, but as a group, they've decided that the market is unique, therefore a unique strategy may be required for the market. So here the XYZ India is acting as a normal distributor, right? It will not make a loss at a gross level, because obviously I will not want to buy a product which I can't even sell for a margin. But XYZ India is taking on its own account the other expenses. So therefore, the greater the volume, they will be able to offset these other costs and make a more than normal return should they have the ability to penetrate the market. Whereas in PQR's case, PQ are saying, I will take the entire decision, the risk of whether the campaigning go well or not. You just go execute what I tell you. So here we might end up concluding that PQR India is a limited risk distributor. Therefore, they have to be assured of a net margin. So because of this difference, primary difference, XYZ India, we might, conclude that resale price method is more appropriate, and in PQR, we might conclude that TNMM is more appropriate. If you do the other way around, right, there would be issues, and defending it would become a challenge. So here, yeah, so sorry, just to conclude, summarize, the takeaway here is, therefore, both are distributors, but the entity characterization plays a very relevant, significant role in choosing the appropriate method. Now coming to case study 4, so here we are told that this Novartis India is selling tablets to the US company for 100 kgs at 90 per kg, and it has some third party customers in India to whom it is selling 10 kgs at rupees 100 kg. So what would be the appropriate method? How would we approach the TP analysis or the defense for this is a question. So of course, there will be a temptation to obviously start by trying to apply a cup method, even though the price charged to the third party is higher than the price charged to the related party. We might, explore further in terms of whether the price difference is because of volume discount, because of confirmed orders, or because of a lack of marketing cost attributable to the US. There might be some difference in the shipping and the freight cost as to who bears, whether it's CIF or FOB. So, but that there is a temptation to look at whether I could apply cup and thereafter kind of make adjustments to these prices and establish. And there is nothing wrong with it. If cup is, even though we don't have a prescribed hierarchy of methods, generally cup is understood to be the most superior method. But what could be the questions that could come up from a tax officer, right? The geographies are different. So, even though you come to some conclusion after an adjustment, there might be still an expectation that the US company has to pay more because their end price will be far, far higher. It's a developed market to which you're selling. So the geography to which you're supplying, the two are different. The quantity itself is different. Therefore, how much ever adjustments you do there, it is not a very reliable situation to compare the two. So therefore, I might look at applying a internal TNMM method. What do I mean by internal TNMM? That I could see how is my segment to only third party sales looking at net margin level versus my segment to AE segment looking like. If that is again a good methodology to adopt, we could try and put the segmentals and see, can I say that if the overall margin from the AE segment is at a overall level higher than the third party segment, then I am still at arm's length. But this may not entirely be acceptable if the sizing of the segment is like this, right? Like 10% of my sales is from third parties, 90% is from related party. Then I can't compare this segment with this segment because it's really a small business for it to independently establish any kind of a profit metrics. In that case, then I would again resort back to a external TNMM. So what is the takeaway that I want to leave here is that most of the time there will be one or two methods or three approaches that might be good. And in a situation where it's not substantially adding, to the efforts or the cost of maintaining the documentation, we should try to add as many corroborative analysis as possible to give more weightage to the documentation and substantiate that whichever way you look at it, I am still proving that I'm at arm's length. So the other objective is this exercise will also give us an indication that that this is a potential loophole or the potential weakness that the client has, and you could possibly indicate to them. So what I mean by that is, let's say you did an internal TNMM and the margin difference was so exorbitant that the third party margin was way higher than the AE margin. Do you have a reasonable basis? Is there a good economic reasoning for this difference? If not, that is something to be highlighted to the client as to say that, if somebody were to look at your segmentals, you will really get into trouble. So here we are told that there is X Limited India, which purchases a product from XYZ US, purchase products worth 100 kgs at 90 per kg, and it onward sells the same products to third parties in India. The sale has happened up to 90 kgs, but it has sold it at 100 per kg. Now, then we are also given this additional fact pattern that the US is selling to India at 90 per kg, but to third parties in the US at 80 per kg, and to another group company at 90 per kg. If you see, both the group company sales has been at the same level, which is 100 kgs at 90 kg, which is however higher than a third party sales, which has happened at 80 per kg. But it's important to know that the quantum is, substantially higher than what the quantum is to the related party. So if now in many instances we will not even get such a summarized information from the client, but at least an endeavor could be made to get these cup details as much as possible so that we could take an informed view. So how would we approach this transaction? Again, we will be, in a sense, tempted to see if we could make the cup method apply. We would also say that to other related parties, it's at the same price, even though it will have no weightage from a technical standpoint. Therefore, possibly here I would think, because XY, on the assumption that XYZ India is purchasing and selling to third parties without any value addition, a resale price method may be an appropriate method. Assuming XYZ India takes the entire risk and strategic decisions for the market. If not, then maybe TNMM itself could be applied. So there were some questions. I'll just pick those questions before we look at this case study, which is the last case study and slightly longer. So I thought I'll finish the questions before we take up this.
Madam, there are a couple of questions.
Yeah, I've.
Yeah, you can see in Q&A.
Yeah, I'm able to see that. Yeah.
Yeah.
I'll take up this question. So there is a question wherein they've said that an export turnover of 1.5 crores, whether it's mandatory to undertake TP study when the company adopts safe harbor rules. Interesting. I mean, a good question. If you basically see that by definition means, I'm establishing my price at a slightly higher price than what is arm's length price. But there is no specific exemption given from Rule 10D requirements. The moment you've exceeded 1 crore, you have the obligation. But practically, once you've opted for safe harbor, you don't need to essentially do like a detailed documentation. So what alternatively you should, try to establish is that safe harbor has certain conditions. That is, you have to meet the insignificant risk provider for you to prove that you are eligible to opt for safe harbor, right? So that is what you would still therefore need an FAR which establishes that the risk control functions for this operations is with the foreign company and India is not taking any of those. So there are certain conditions given in the safe harbor rules. Your FAR should follow, FAR should ensure and establish that you satisfy all these conditions, and therefore you're an insignificant service provider bearing insignificant risk as defined under the safe harbor rules. Then that you have adopted for the safe harbor rules and the quantum is below so and so threshold and therefore eligible for 17% markup. So the point is the entire 10D documentation with economic analysis is not required. It might not make sense because when the rules prescribe a margin for me, why should I again do a comparability analysis? But nevertheless, I might still have to have the other information surrounding like the group overview, other transactions. You might have other reimbursements, recovery transaction, etc. All that would get reported in that documentation. AO has passed order for adjustment of 3% on overall turnover. We are paying royalty interest on AE loan. Since we have all documents for royalty and paying only 2%, it requires them to adjust only on AE transaction excluding royalty. I'm not fully following, but let me take a stab at it. So there is we are paying only 2%. So I am assuming you're paying a royalty of 2% on third party sales, and there are other interest transactions which we can ignore for the time being because your interest expense is a financing expense, so you will not consider it when you do the TNMM analysis. So that needs to be separately benchmarked and established that the interest transaction is at arm's length. but the royalty transaction could either be done using a cup or a TNMM. And I'm assuming here that there are other AE transactions like imports, etc. And the margin is the 3%, I'm assuming, is the margin adjustment made by the AO. You would have had something that's lower. So the question is, whether you can ask for the adjustment only for the other transactions. So when you have the royalty transactions and other transactions, this is a downside of using a TNMM. The moment you club the whole thing together in one wing, adjustment can happen to any transaction. Yeah. Yes, sir. So do we have time to take the last case study, or should I conclude?
Madam, Narendra sir also is already joined. If time permits, you can take up at last.
Yeah, sure. Hi, Mr. Narendra.
Good evening, sir. Narendra sir.
Sir, good evening. Hi.
Good evening. Good evening.
Hi, Vaishaka.
Hi. Yeah, so I have one case study left, which is actually kind of a long case study, but I think, as sir was saying that.
No, if it is last case, you can continue and close it, madam.
Yeah.
What, sir? Narendra sir, with your permission.
Yeah. Sure. Let us close it. Yeah.
Please,
sure.
madam, please.
All right. Okay, thank you. So, so what I've essentially tried to do in this case is that we look at a very detailed fact pattern, which is typically facts that you would see in any kind of setup, and look at, analyze it transaction by transaction as to what the approach that one would have to look at. So I'll read out the facts. So ABC Inc. is an electronic component manufacturer based in Sweden. So we have a foreign company and it has a subsidiary in India, which is ABC India. ABC India as a manufacturer has the following transactions with its parent. So what are the transactions? We are told it sources some components from the foreign company. The components are used to manufacture and manufacture CD players, basically some, electronic equipment. Then it also imports the finished CD player itself for the purpose of resale into India. The assumption or the understanding here is they are different models, that some models are manufactured and sell, some models I'm importing and selling in India directly. For the purpose of manufacturing, the ABC India is also paying certain royalty for both the brand name and technical know-how. And for this whole operations, it's taken some loan from ABC Inc. Now, we are also told for the manufacturing, ABC India also sources components for its manufacturing function from unrelated parties. And that ABC India purchases CD players from unrelated entities for resale purposes. So which means this gives an indication that it not only deals with the group's CD player or the product, it also purchases CD players from unrelated parties for resale purposes. And then lastly, the ABC also sells CD players to group companies in Thailand and also to unrelated parties. So just to a quick snapshot of what it does here, between Inc. and India, it imports finished goods and there might be a resale to customer. It imports components used to manufacture and export to related party and sale to third party. There might be purchase and sale of the finished goods itself from third parties, and it pays a royalty or a license fee to ABC Inc. It also procures components from third parties, and then there is an availing of loan. So this is the holistic fact pattern that we have. Let us let us see now how we would go about looking at this in respect of each transaction. So obviously, when I do the analysis, I will have to, at the end of the day, I'm trying to report each of these transactions and then come to a conclusion on what is the appropriate method for each of those transactions, and accordingly choose the method and do the analysis. But in doing so, there is this concept of aggregate approach. That is, if I believe there are more than one international transaction which could be looked at, evaluated, and analyzed together, then I follow what is called an aggregate approach. In the earlier examples that we talked about, let's say in an example where I have applied TNMM in a case where there is a royalty payment and there are other transactions, we are essentially doing the aggregate approach, that there is transaction of royalty also, transaction of certain imports also, there might be exports also. We've taken a view that all these has to be looked at together because of the economic linkages of each of these transactions, and that it cannot be reviewed independently. Typically in a transaction which is so embedded, we might come to that view. But let's look at the principles that would let us to what are the principles that we have to check for to enable use of the aggregate approach. So first let's look at the finished goods situation, right? Because there is one manufacturing activity, one distribution activity. So I will look at the distribution activity first. Under the distribution activity, we are told I import the finished goods from AE and resell it. And I also buy from third party and sell it to customers. Now, the fact that, and then so here also another relevant fact pattern that we have to keep in mind is that ABC India is also manufacturing and selling. So this kind of gives a picture that it's an established player in India which is doing multiple businesses, whether it's its own manufacturing or procure from related party and sale, or procure from other party and sale, which means ABC India would have spent adequately on the sales network, advertisement, brand promotion, any other channel partners, etc., holistically towards all these 2 or 3 products that it is dealing in. So if I have to look at the distribution segment separately, just from the perspective of I import and sell to the third parties, one approach would be to say that I will do a resale price method, because without any value addition, I import and sell. Now this if I adopt this would indicate that I should be able to come to a segmental item on only the sales made to third parties from the imports. Of course, we look at a gross profit level, but you would still need to come to a fair estimate of the direct cost, etc., that is attributable to the sale to third parties which are of imported series. Now, if my purchase and sale from third parties, entirely a third party business, has a bearing on this, then, and if it is sizable, then there might be an additional fact pattern that could indicate that RPM may not be able to reliably be established. Another fact pattern that I have seen is that typically, if considering the manufacturing size of manufacturing operations and distribution operations, if the distribution operation is very small when compared to the manufacturing. So typically what happens is, ABC India is established as a manufacturer, but it would also undertake distribution just to deal in products which does not have substantial volume that it can't set up a manufacturing facility for. So till such time there is adequate penetration in the market, they would want to import and sell. In such an event, you might see that the overall economics would suggest that the distribution segment is also very closely related to the manufacturing segment. And therefore, you would probably be able to combine it with the manufacturing segment and look at it together. These are not conclusive remarks. I'm just saying that how in different circumstances, you might be able to look at it differently. So to summarize, RPM is the best suited method when it comes to a distributor. But if the distribution business is not entirely import from AE and resale to third party, but has other substantial third party businesses, and you're not able to independently segregate the P&L, you might have to look at doing an alternate analysis. And where distribution itself is an outcome or closely related to the manufacturing business, then you could also consider evaluating it together with the manufacturing business. So when I say together, what I mean is, so let's say ABC India is scouting for customers, tries to penetrate, get new customers, educate about the product, etc. When they would go as one sales team, and it's the customer preference that they want one model over another model. That model, some of the models I might be manufacturing, some of the models I might have to import and buy, some of the models I might have to buy from some other third party. And so, but it is one business, it is economically, it's one sales team which is going and kind of scouting customer. This would be one of the reasons why it can be all looked at together. So that kind of answers the import of components as well, which is obviously linked to the manufacturing unit itself. And therefore, whatever is the methodology I would choose for the manufacturing unit is what would go into that. Now, we have told we've also procured components from third-party suppliers. Here, one has to evaluate whether a deemed international transaction exposure is there. Typically, in these cases, if these are proprietary products, ABC Inc. could have said, some products I'll give you, some products you buy from my established vendor, because that vendor himself has been set up as a for the purpose of the group. So a direct purchase from third party doesn't automatically mean it was from third party. We will have to test if there was element of deemed international transaction. Lastly, the payment for the technical know-how. We already discussed, for a royalty, it is always preferred that you do a price analysis separately and establish that the payment of royalty on a standalone basis is at arm's length. And then anyway, that cost goes into your overall TNMM analysis. So coming to the TNM analysis, so for the manufacturing unit, it is fairly clear that we would look at a transaction net margin. But the question again comes, how do I justify the export sales? That again depends on how sizable is that, export transaction. If it is almost, if it is a sizable business and, if one were to say 50% is from export, 50% is from third-party customers in India, then I would try to evaluate, I would do a segmental analysis and look at the export business independent to the third-party segment. We might also be able to see if internal TNM works, but it kind of becomes too complex because on one side you have purchase transactions and on the other side you have sale transactions to AE, but at least a segmental check, because your overall net margin comparability analysis might be similar, but you have to still establish the margin at the third party segment and the export segment is separately disclosed, so that we kind of establish that both are at arm's length even when looked at independently. Yeah, so just one point, I think I already covered that also. Most of the times our choice of methods and approach to the analysis is kind of limited by our own access to the various databases. So in certain instances, it could be a situation where for the import of finished goods, especially if ABC India is a low margin company or a loss making company, you might want to evaluate if you could take ABC Inc. as a tested party and look at the foreign comparability analysis. Like I already mentioned, it's definitely the cost of maintaining the documentation has to be commensurate with the overall value of the transaction itself. Where it is not, it is a discussion that one has to have with the client, saying your documentation will be more superior if this approach was used. But you could also go down the approach of doing it once and then carrying it over, using that corroborative analysis over 3 years or so and then refreshing it than doing it on a year-on-year basis. Yeah, so that brings me to the end of my presentation, and thank you so much for being here today, and thanks again Bangalore SIRC for the opportunity. With this, I would conclude and hand over the session to the next speaker.
Thank you, Sri Vaishaka, for excellent presentation. Request Divya to present.
Yes, sir. Thank you so much, sir. On behalf of all the participants and also on behalf of entire managing committee, I thank wholeheartedly Vaishaka ma'am for sparing your valuable time and giving an excellent presentation. Thank you so much, madam. Thank you so much for also clarifying all the questions of our participants. Thank you so much. Now we shall move forward for the next session. We have with us CA Narendra Jain sir to present our next topic. To give a brief introduction about him, by qualification as BCom, FCA, Company Secretary, LLB. He is All India 5th rank in CS Center, awarded DL Majumdar Silver Medal for securing highest marks in Advanced Company Law and Practice in CS Final. Also Taxman's Prize Award for highest marks in direct and indirect taxation. Also, he has been awarded Mrs. Pankajan Rangachari SIRC Prize Award for securing highest marks in Advanced Company Law and Practice in CS Final. He did his articles in Kinchanco and also worked there. Presently, is practicing an advocate heading NNMS Legal Chambers, Bangalore. With this very brief introduction, I wholeheartedly welcome to you once again for today's program, sir.
Welcome, Narendra sir.
Over to you, sir.
Thank you, sir.
Thank you.
Shri Srinivas, Vice Chairman, thank you, sir. Divya, thank you. I would like to start with thanking the Bangalore branch for again giving me opportunity to share my views on a very interesting topic, the impact of COVID on transfer pricing analysis. I'll just share my presentation to start with. I hope the presentation is visible.
Yes, visible, sir. Visible.
Yeah. So it's like various aspects of last 1.5 years, the way COVID has impacted all of us. The same thing is with transfer pricing. The various restrictions which are there in lockdown, night curfew, movement of people, movement of goods, disruption of. So all these things have had a great impact on business and its profit. Global trade has been impacted because of restriction of travel restrictions and various other restrictions. And a lot of things, the way we do business has changed, especially the work from home culture and a lot of other things. The technology based businesses have done well, certain businesses have done bad. So the idea of this presentation is to analyze certain areas which we need to be careful while doing our transfer pricing study, transfer pricing certificate for the years impacted by COVID. No doubt, first we need to deal with financial year 2021, assessment year 21-22. Even current year, as we all know, there is an impact in the first quarter at least. We don't know if there will be impact in subsequent quarters. So how do we handle these issues in our transfer pricing documentation in Form 3CB, how we handle these issues? So the idea of the presentation is to try and analyze certain solutions, certain issues, and what could be the probable solutions to them. Various countries came up with clarifications on this. OECD came up with certain clarifications. Australian Tax Office, ATO came up with clarifications. Singapore government IRAS came up with certain clarifications. From the Indian perspective, we do not have any clarification on treatment of issues arising from COVID. How do we treat in the transfer pricing? In fact, unfortunately, we do not even have safe harbor rules for financial year 2021. Like many other situations, the taxpayer has to grapple with these issues by himself and wait for the assessment to happen, which will happen to 1 or 2 years down the line, when the scenario would be different. So today, what is the scenario and what would be the scenario after 2 years in terms of especially the data availability for TP will be different. So these aspects are very relevant. And given that we do not have any clarification or any modification in the rules, we need to, at our end, try to take as many precautions we can do, try to gather as much of evidence as we can gather, create as much of better documentations that we can create, so that at the time of assessment, we are able to sustain the positions that we take today in our TP studies. So there has been impact on various levels due to COVID. One is demand contraction in certain industry segments. Certain segments saw a better sales. Cash flow was one issue which was there in many industries, because there was a lag in collections, and many industries had to extend the credit periods. Swings in profitability, one quarter saw good results, one quarter saw bad results, and huge amount of movement in that. Supply chain, as we even talked today, there are issues in various industries. Chip industry is one where, because of huge demand and supply constraints, there is a sudden requirement, and it is impacting industries like auto. Then you have work from home coming into picture, which impacts various aspects in terms of what assets are procured. Like a lot of people had to move from desktop to laptop, incurred additional cost on that. There was an idle time in between for the transition to happen from normal work culture to work from home. How do you treat those costs that in between period, those costs might have been incurred? The closure of factories or offices or shops and restaurants and travel especially, it has been implemented in different places in different ways. Not just across geographies, across countries. Even in our country, we will see that some states had more stringent lockdowns, though the first lockdown was similar across the country, but gradually things changed. As the things moved forward during the year, second wave, we saw that the closures were different, the lockdowns were different. So today, when I do a comparison of an assessee who is coming from a zone where there are stringent lockdown and he had to close his factory or office for a much longer period, his profitability would be impacted higher when compared to an comparable who is coming from a state where there might not have been that longer a lockdown. Even change in districts could be different, impact different in terms of how many days a particular factory or industry was open and how many days it was closed. So how do we handle these kind of a situation? The TP policy generally, when we have set a TP policy, whether for captives or whether for any other industry, those were keeping in mind the normal market economy, that these normal business activities would continue in so and so manner. So if a cost plus business model was adopted, that was on the assumption that this is how the services would be rendered and this is how the remuneration for services would be paid. So if an LRD, low risk distributor model was adopted, it was on the assumption that the distributor would be able to fetch the sale orders and the goods would be provided in required time and the sales would be made. But today, when the country is under lockdown, the sales are not, the assessee is not able to get those sales order. Suddenly you will find that the low risk distributors fixed cost is higher than his gross profit, therefore resulting in losses. So these issues need to be addressed today when we do our transfer pricing documentation. So what are the issues arising? First, the issue we deal with the legal issues. What are the legal framework within which we are functioning? Legal framework within which our law provides us to compute the arm's length price. As we all know, section 92C provides for the methods. It takes us for the computation purposes, it takes us to the rule 10B, rule 10C, rule 10CA. Rule 10B says for a particular method how the computation needs to be done, ALP computation needs to be done. Now, rule 10CA, which was brought in 2014, was with the objective that earlier when only single year data could have been taken. Now, that single year data was causing certain issues. Also, there was a concept of arm's length price, which based on the arithmetic mean, which was getting impacted due to extremes. So the tax officer used to take one company with more than 100% margin, and suddenly you will get an average margin which is very high. Same with the assessees. Assessees will try and take a low margin or negative margin company, and suddenly you'll find a better margin. Multi-year data and earlier year data was required because at the time when the assessee was doing the transfer pricing study, this data was not available. Current year data was not available. Therefore, the 2014 amendment provided that in methods like RPM, CPM, CPM, and TNMM, the multi-year data concept was provided. It was not provided for CUP and PSM, especially for CUP because you're doing a comparison of prices. So there this issue does not arise. So for these three methods, the weighted average margin of 3 years was permitted to be taken. Rule provides that you will take the current year data of the assessee and compare that with the weighted average margin of 3 years of the comparables. So comparables, you will take the current year plus previous year 1 and previous year 2. Whereas for the assessee, you will only be taking the current year data. So this was the comparison which was being done and which was accepted from last 5 to 6 years. It was being implemented. Now, because of COVID, suddenly this becomes one of the issues that need to be addressed, which the rules have not been modified. So currently the rules way it provides is, so if I take the financial year 2021, which is an year where the impact of COVID will come for the assessees, tested party. Now, suppose this company assessee is into manufacturing of certain items. Its operations should be impacted by COVID. So when I do the transfer pricing documentation today in September or October of 21 for financial year 2021, in most of the cases, we would find that the current year data is not available. So what data is available is of the preceding year, and rule permits me to take the data of the preceding 2 years. But the main point or moot point is, can I compare the current year data of the assessee with 2 preceding year data of the comparables? Those 2 years are years where the normal operations were going on. There was no impact of COVID. March 20, except the last fortnight maybe, where there was a small impact, but otherwise the entire year was having a normal operations. Rules do not address this kind of a situation, and no attempt has been made to clarify this particular issue also. As we go forward, when the assessment comes up, the officer would have the data of financial year 2021. At that time, no doubt assessee also would have access to the data of 2021. So how do one look at this situation and address the same in the transfer pricing study? So today when we do the transfer pricing study, the option that are there with us are very limited. So possibly we'll only have a choice of taking the current year data of the assessee and preceding year data of the comparables, because very few cases we would be able to get the current year data. This problem becomes aggravated in TNNM, and most of the cases all of us know that we use TNNM. This problem would not arise that much in CUP because the comparison would be on pricing of a particular product, and if you have a close comparables of those CUP pricing, then that would not be that much of a challenge. But in TNNM, because the margins get impacted and the kind of disruption is there due to COVID, and it is different for different people. So that would be a very major issue that one has to address. Possibly, we will have to use current year of the assessee with preceding 2 years of the comparables. Now that will give rise to difference. Rule 10b3 says if there are difference, it needs to be adjusted. So analyze whether there's a difference in enterprise or difference in transaction, and try to make an adjustment for those differences. And if you make an adjustment for those differences, then how to do those differences, we will see as we proceed further. But that could be one option for us to make an adjustment for differences for the preceding 2-year data. But the situation would change when the assessments happen, for the reason that the TPO would have a current year data at that point of time. Even assessee would have access to that current year data. So when that current year data is done, then again there will be asymmetry there. Because if I use multi-year data of the comparables, the current year plus 2 preceding years, 1 year COVID and 2 years non-COVID, then that would again give rise to a situation where if I assume that it is 1/3, 1/3, 1/3 weights, though that would not be the situation, just for the purpose of assumption, then 2/3 of the comparable profit is unaffected and 1/3 of the comparable profit is affected. The law does not visualize a situation to address this anomaly. Can then one say that at the time of assessment, I will only compare current year with current year of the assessee and current year of the comparable? Law does not currently permit that situation. Unless a rule is modified or clarification is brought by the board on this particular issue, this challenge will remain, this difficulty will remain. Hopefully they address this situation and clarify what kind of data should be used. So this is one difficulty or issue that arises which is unique to COVID. This may again not survive. This issue will remain for next 3 to 4 years, because what would happen is, suppose in March 22 or 23, when the situation normalized, the assessee's entire financial year will be a normal financial year, but the comparables, because you're using a multi-year data, you're going for 2 years backward for the comparables, there could be a situation that the earlier years of comparables are impacted by the COVID. So the comparable would have 1 normal year and 2 COVID years, assessee would have 1 normal year. So this situation needs to be addressed for this entire period. Clarification needs to be brought in by the board for this entire period, that how this situation will be addressed. Given that we are already in August, September, and very little time is left for doing the documentation, not sure if any clarification is going to come on this. We will have to resolve this in terms of our documentation. We'll try and see some suggestions, some solutions, what I think would be relevant, we'll discuss as we go further. But this is one issue that needs to be addressed. Second problem, assuming we have current year data, what would be the quality of comparable data that would be available with us? Suppose I know that 45 days I have been impacted and have a lockdown for 45 days. Today, we would not know whether the comparable has similar lockdown for 45 days. The institute has given the guidelines for financial disclosures due to COVID. Hopefully, the quality of disclosures are good for us to be able to understand what has been the impact on the comparables due to the COVID. If that disclosure is good, then that data could be used by us to see that what is the impact on the comparables because of the COVID. And that should be documented as part of our transfer pricing study. Industry and geographic comparison. If you see Bangalore, where we have huge amount of captives, ITS captives, we have not been worried about the industry classification that much. We were worried about whether the comparable is in software industry. If the comparable is in software, we would take that as a comparable. But today's situation is not so. Because if I see my own clients, one client who is connected to chip industry is doing fantastic business, and he believes his business will double in next 1 year from what he was prior to COVID. And someone who is in a travel industry is struggling. He had to fire people, and there is no business even at the parent level, who was developing software for travel industry. So these are very huge gap in certain industry segments due to COVID. So today, when earlier we were doing comparisons, if we were saying, okay, chalo, SSE's software and comparables are also software, we take it as a comparable. We were not worried in terms of industry classification of the comparables. But that could be a relevant test that we need to see today when we are doing the transfer pricing analysis for IT, ITS or other industry segments. Especially if you are providing a services to different industries, this could be relevant. Now, if we see industry classification, the challenge will be to get comparables, which may not be available that much. Second, the comparables that data today we have, if you see certain large companies, they provide services across industry. They don't provide for one or two industry. You could get segmental data in certain comparables where industry segments are given, and you could make out that the profitability of particular industry is there. That data will be useful even in assessments. For example, if there is a large company which has 5 segments and you realize that the travel segment has made a loss, then you can demonstrate that even the third parties were affected because of COVID. And no doubt that might have got compensated by a better business in other segments of insurance or some healthcare, etc. But there is an impact in certain industry segment, even if it is a software company. But because the general understanding today, software margins are not impacted because most of the listed software companies are doing good. But that may not be the situation depending on which industry segment a particular software company is catering to. So this data of industry should be trying to be looked into. If possible, try to get closest comparable in the same industry. Not sure how much comparables we would get in that particular industry, but we should make an effort in that particular direction. Plus the segmental data could be helpful. Segmental data of particular industry could be helpful. Geographic, when I mean geographic comparison, if I'm providing services to the geography of both where I am based and where my customer is based. So if there could be this issue arising, especially because of lockdowns being different in different parts of the country. As we all know, India is so large that the COVID impact is different in different areas, not just states, but even districts. So while doing this analysis, it could be possible for us to look at this angle also and try to get comparables which are close match in the industry and close match in the geographical location. That would help to ensure that the comparables equally affected as the tested party. And at least we don't have to go to making too many adjustments, which are sometimes difficult to get through at the appellate levels. So this is one angle that we need to look at. Delay in collections. This is well-known issue which has happened in last 1 year, where there has been a cash flow constraints across the board. There has been delay in payments. And one very regular adjustment that we see in the transfer pricing assessments is the interest on receivables, notional interest on receivables. So if you have receivable from the related party, and if it is not received within the terms specified in the agreement, suppose your agreement says 30 days or 60 days, and you don't get within that period, the tax authorities have been consistent in doing this addition on the receivables at LIBOR plus some rate or based on the DRP is taking the Indian FD rate sort of term loan rate. So this could be one issues where we will have to again see what has happened, because suppose I am providing, if even India is a manufacturing company and sells to its wholly owned subsidiary who is acting as distributor in US or European region, but it may have difficulty in collecting with the end customers because of COVID, because of lockdowns, because of cash flow at the end of the end customers. So the India will be forced to give extra period of credit to the subsidiary. So that needs to be appreciated. That these are situations where there are cash flow constraints, and the proper documentation for that needs to be done, that why there was delay in collection of these amounts. Hopefully, again, here we get some benefit that the tax officers do not take a very aggressive position that whenever there is a delay, I'm going to make an addition for notional interest, and they give a benefit due to COVID that there is a delay. And even in third party scenarios today, when we are asking our customers or when we are making payment to the vendors, we are seeing that everyone is accommodating. Everyone knows that the survival depends on a free cash flow, and survival of each other is dependent on each other. And therefore, everyone's survival is important. So everyone gives that benefit today for an additional time for payment. And this should be factored in while doing the transfer pricing analysis. Next is the additional cost where might have been incurred because of IT infrastructure, purchase of additional laptops, and things like that. It could also be a lot of additional cost which are employee specific vaccination issues and hygiene issues in the office sanitization related expenses. A lot of these expenses might have also been incurred during this particular period. How to treat those costs? Can you say that these are normal operating costs? Are they normal? Are they non-operating costs? Are they extraordinary in nature? Two important aspects that we will have to keep in mind for these costs is what is the comparable situation one. Now, I don't know again how much of data we would get in public domain for these kinds of costs, and therefore what adjustments one could be able to do for that. But this is one important criteria for us to do that. Second, how do I demonstrate that particular cost is extraordinary? Is the cost substitute to an existing cost? I might take a Zoom subscription or make some IT related work, but then my travel cost must have gone down. So is my cost substitute to any other cost? And then it is a part of normal business cost. We'll try and see some examples on this as we proceed further in the presentation and see what could be the cases in which we could treat some of these expenses as non-operating or extraordinary nature. We'll have to balance this approach with the deduction of expenditure under 37. If we talk too much of these expenses, we should not risk a disallowance under section 37 for these expenses. So a balanced approach for these expenses will be important in these matters. The last bullet on this slide, whether the adjustment can be made to the tested party. It's not an issue which is arising out of COVID, but nevertheless, what is important here is the data kind of data we'd all have. It is more easy to make an adjustment to the assessee. Assessee's cost, assessee's revenue, and assessee's profit. You try and say that this is ordinary, this is extraordinary, or this is the ideal capacity of the assessee. So that kind of data is more easily available to the assessee. Earlier, tax authorities were taking a view, and in fact consistently taking a view, and it was easy for them to reject any adjustment on a simple ground that the adjustment should always be made to a comparable revenue and cost and not to the assessees. For this purpose, they relied on Rule 10B(1)(e)(3), which says that whenever there is a difference, that difference should be adjusted to the margins of the uncontrolled transactions. So they said adjustment always should be done to the uncontrolled transactions, to the comparables. Now that becomes very difficult. For example, if I do an idle capacity adjustment to an comparable and not to the assessee, then to find out what would be their fixed cost, their capacity utilization, then extrapolate my capacity utilization to the costs and revenue of the comparable is not that going to be that easy. I'll give an example in my own assessee's case how this panned out. We had made there was a supply chain disruption because of, and substantial disruption because of floods in Thailand. The parts could not be procured because there were floods in Thailand, and my supply chain was dependent on those parts. So substantial additional cost had to be incurred to get those parts on time so that the manufacturing line was not impacted. Now, the comparables did not have the same supply chain. They were procuring local parts, and therefore there is no impact of this Thai flood on their manufacturing lines. Now, if the department takes a position, which it took in that particular case, that the adjustment should be done to the comparables. Now, how do I assume that the comparables are also procuring parts from Thailand? Their supply chain is also disrupted because of the floods, and they are not able to procure parts. Therefore, they will incur additional costs. So it is not a workable proposition at all. So therefore, the adjustment should be made to the tested party and not to the comparables is one of the legal arguments that have been come across in the courts. And luckily to the rescue of the assessees, the courts have accepted this proposition that the adjustment can be made to the tested party also in Rule 10B 1E Clause 1 itself. The Aristothermos case was the first decision which took this line of argument, Pune Tribunal decision, and it has been post that accepted by many tribunals, and it is a well settled position. So we should be able to make an adjustment to the tested party. No doubt there are few contrary decisions, and department would try to take benefit of this, but as the matter travel to the judicial fora, we should be able to get a favorable outcome in those cases. There could be idle capacity arising due to COVID. One, either due to lockdown, you were not able to do the operations. Second, you were transitioning from the normal work hours to work from home. In transition, the time was lost. You had to procure laptops for them. It might have taken 2 weeks, 3 weeks to organize things, to organize IT infrastructure for things. In that, the man hours might have lost. How do you take care of those? Then there could be situation where the parent which is outside India is shut down because of lockdown and it has not been able to give sufficient orders. Or there could be other problems which we have seen, that the supply, the raw material supply is constrained, and therefore you are not able to operate at the normal capacity level. The idle capacity adjustment is something which has been recognized by courts in various decisions. We'll discuss some aspects of these as we go forward in the presentation. And that could be something which we could think, but all of these requires a good amount of documentation for us to survive. COVID-19 specific cost, employee cost, we'll see further. Now, two last bullets in this. Can a limited risk arrangement like a captive unit incur losses? And the budgeted financials, can a budgeted financials be used for the purpose of benchmarking? I'll take the last bullet first. When you talk of budgeted financials, see, prior to COVID, most of the companies would have internal budgets that this could be. So in March, first week, they have come up with a budget that this could be my operations. This is my revenue. This is my expense. And this is the profit which I have to make, which should have been approved in the board, in the shareholder, by the parent company, etc. So can that be a basis of doing a benchmark, given that this is an abnormal year and the situations are such that there will be a difference between actual reality and the budgeted figures? I could not reach the projected or budgeted figures for the reason that there was a COVID. But for COVID, I would have reached that budgeted figures, and I'm able to establish that kind of a situations. Now, this approach has been recognized by some countries, like the ATO ruling, ATO guidelines on on COVID-related transfer pricing issues. They have said that we will accept the but for approach. That means, but for COVID, what would have been the situation? But for COVID, what would have been the situation? But you will have to make a detailed analysis of profit and loss account. Profitability analysis has to be detailed. How the cost allocation has been done between the related parties, and if there is any government assistance, things like that. All those documentation should be maintained. So that could be one way where the tax authorities in that country has accepted this approach. Even the OECD guidance note on the COVID talks of this there. But in the Indian context, whether this will be an acceptable situations. We had two judicial precedents on this issue. One was the case of Jordes Overseas 45 SOT 375. Now here the assessee was operating at a very low capacity. it redrew its financials on an assumption that it is operating at 100% capacity. For example, it was operating at 40% capacity. It assumed that it is operating at 100% capacity, and based on that 100% capacity, it redrew its profits and loss account. It said that this would have been the probable sale, this would have been the probable cost, and therefore my profitability is better. This was not accepted by the tribunal. The Delhi tribunal said that the comparison or the comparability and ALP computation will have to be based on the actual financials, actual figures, because when you talk of net profit realized from international transactions in Rule 10BE1, we are talking of actual net profit and not an hypothetical net profit based on your hypothetical projected financials or rework financials based on 100% capacity. Similarly, there was a case of Magneti Marili, again a Delhi tribunal decisions. Here, it was projected financials were made the basis of ALP calculation. Projected financials were made the basis of ALP calculations. The Delhi tribunal did not accept this. So these two tribunal decisions give it is not going to be easy to use budgeted figures or projected figures for ALP computation unless the government itself blesses it or makes certain provisions in the rules to permit it. The way existing rules read and based on the judicial decisions, though these judicial decisions have nothing to do with COVID, and maybe some court says that during COVID time we can accept for this but for approach, but those are all something which we need to go into litigation and test it out and go through that process of litigation to get a favorable decision. So that making a budgeted financials information, making a basis of ALP computation is a sure shot invitation for litigation, not benefiting the company and benefiting only the consultants. So I would not feel that it would be an appropriate approach. I would feel that it would not be an appropriate approach. Then issue comes as the limited risk arrangements. When the entities which are operating at limited risk, when they are operating at limited risk, can such entities be incur losses? Can incur losses? For today, when the captive units, which we see Bangalore kind of a situation, where they are having the cost plus model. So I incur costs, those costs are marked up. The agreement says all costs to be marked up. Idle cost is not an issue, all costs will be considered. Whatever is the cost incurred by the Indian captive will be marked up. Similar situations would be for no risk distributors, who would then also be assured of a net margin, and their job is just to get the orders. Everything else, all other risks are borne by the parent company. Now, in such situation, just because of COVID, can you then say that I will change the model, or I will say that I'm not going to compensate them on a cost plus model, one, or alternatively, there are certain costs which will not be marked up and certain costs will be marked up. For example, if I'm having 100 rupees as a cost, out of that 40 was idle because the employees could not get sufficient work because the parent itself did not have the orders to pass on to the Indian captive, then can I remove that 40 or 60, 40 from the cost base and mark up only 60, and 40 either will be compensated at cost or will not be compensated? Can that be done? Similarly, in a low risk distributor model, suppose the credit risk was always with the parent, an Indian entity never taken the credit risk. Now, when there are suddenly bad debts because of COVID, can you say that this bad debt will be borne by the Indian company? The agreements would not provide that. Now, if you want to change, one will have to start from the agreement to change this. If you don't change the agreement and just change the financial statement, it is again going to be difficult. Now, can this arrangement be changed by changing the agreement and they not compensating the Indian captives? The ATO's paper discusses this. The OECD also, the guidance paper also discusses these aspects. Then can the agreement be changed? Both of them try to say apply the golden rule. Whether an unrelated party would have done this. Suppose there was LRD who did not take a credit risk. Now, due to COVID, will he be ready to take a COVID risk, bad debt risk? Due to COVID, whether he will be ready to take a bad debt risk. In an independent scenario, whether a person would have done so. In an independent scenario, whether a person would have done so. If in independent scenario, if this revised arrangement is a win-win situation for both the parties, then it can be implemented. Second, is the change only for this duration of COVID? Suppose subsequently, when things normalize, can the again, once the credit risk will be borne by the parent. Third, what is the additional compensation the Indian company getting for bearing this risk, additional risk? Now, if these aspects are analyzed and looked into and properly documented, then there could be possibility that one could change the arrangement and agreement. But to assume that everything will remain same as earlier, at the same time you take an additional risk of credit risk or idle capacity risk, but I don't compensate you more also, then the tax authorities may not accept such a arrangement, such a revised arrangement. Plus, whatever is the new arrangement will have to be maintained subsequently, and it cannot be said that just because of COVID, I'm again changing it. Suppose you now say that Indian entity takes the extra credit risk, LRD situation takes an extra credit, and if you start, then you compensate him with extra gross profit margin because he's now taking the extra risk. Post COVID, you cannot just go back to the normal situation because anyone in an independent scenario would not have possibly done it. So if these changes are happening in the arrangement between the related parties, one, these will have to be documented properly in the functional analysis in the TP study report. They will have to be viewed from an independent party perspective, whether in a normal situation this would have been accepted. This would have been accepted. So these aspects will have to be seen if there is a change in the arrangement between the parties. Next is some what OECD guidelines say on the COVID, and what are the aspects guidance note of OECD covers this. This could also be helpful for us. To understand and apply this. Now, comparability analysis, the guidance note covers 4 aspects: comparability analysis, allocation of losses, allocation of COVID-19 specific costs, government assistance, and APA. The last 2 parts will not be very relevant for the current discussion because APAs we are not discussing, and government assistance programs we are not seeing that much in India. These are trying to say whether salary cost was borne by the government or part of the salary was compensated by the government, and what would be the treatment of those costs. The comparability analysis and the allocation of losses, for these the guidance note gives certain parameter of what would be the sources of information or what are the parameters that one could be the relevant, like sales volume fluctuation, what was the fluctuation in sales volume for the COVID period, changes in capacity utilizations, what movement was happening in that, incremental or exceptional costs, entity-wide, group-wide, who in the group bears it, and whether there was group-wide IT infrastructure costs borne by one entity, then it should be allocated to the persons who have utilized it. Impact of governmental assistance, then what is the impact of government's intervention affecting the pricing and performance. Interim financials, there's a quarterly financials data which will be available, how that can be used. Macroeconomic information, country-specific GDP data, industry indicators. The idea of this is that these information in an apt case, we should document it. We should try to look at these information and document it as a part of TP study. What the OECD guidance note says is that the taxpayers and tax authorities should use a reasonable commercial judgment supplemented by contemporaneous information that what are the likely effects of the COVID-19 and document best possible market evidence currently available. It also says that one could use more than one method to support the arm's length price. Again, in the Indian context, it is difficult because currently the rule says that assessor will select one most appropriate method, and that has to be used for the purpose of benchmarking. Good guidance is on the loss-making entities, and this could be helpful that one could use loss-making companies as a comparables, assuming all the parameters are satisfied. When you go to next slide, we'll see this. Yeah. Okay. Now, what would be the possible approaches for us to apply during the for the transfer pricing analysis because of the issues what we have discussed? What could be the possible approach that we can take? Now, certain costs which are there arising due to COVID, those could be treated as abnormal or extraordinary items. For example, the transition cost which happened from normal work to the work from home. And in that period, if there was an idle time and there was a time lag which was happening, that was one situation which could arise. Relocation of expenses, changing it, relocation cost related to expenses because you have to move your offices because of COVID or certain related things. So if you take this one segment of expenses, the tribunal decisions in the context of trans-switch, that particular case was dealing with the relocation cost, and relocation cost was there was a ceiling drive in Delhi and the office was closed for certain 45 days. So in those period, they had to move to new offices and provide the infrastructure at the new offices to start the work. The employees were idle at that point of time, and that cost was allowed as a non-operating item and reduced from the while doing the computing the PLI of the assessee. That could be one supporting case which one needs to see. There could be retrenchment cost or VRS cost which the companies may incur. Retrenchment or VRS cost which the companies may incur. One could refer the decision of Vichy component 79 taxman.com 281, where this kind of a cost was taken as non-operating in nature. So these are some examples where the costs, abnormal or extraordinary costs, have been treated as non-operating in nature. One could take support from this. But having said this, the first important aspect is that whether comparables would have incurred the similar costs. So if you're taking, say, 5 companies as comparable, document it from their financial statements whether or not they have incurred these costs. The auditor's disclosure on COVID-19, where they need to make disclosures on COVID-related impact on the financial statements. If there are any disclosures on that count, that disclosure should be useful and should be documented so that we can address this difference in the costs which are incurred by the assessee and by the comparables. But if the comparables have also incurred a similar cost, then possibly we will not be able to sustain these additions whenever this happens. As I said in the beginning, that currently the situation is such that we will be taking the current year COVID impacted financials of the assessee, whereas the comparable data of the preceding 2 years would be available. In such circumstances, the choice that is there with is that the adjustment will have to be made in the transfer pricing study report for these costs, because the comparable financials currently that we used in the TP study will not be of current year, will be of the preceding years, which are the normal financial statements, whereas the assessee's financials are impacted by the COVID related issues. So therefore, this adjustment has to be done, identify these costs, document these costs, and make it a part of TP study this is what we are treating as extraordinary in nature. When it comes to other costs, like example, one procures the in laptops and additional IT infrastructure for operations, for to move transition for work from home. In those cases, analyze the depreciation to sales ratio of the tested party for the current year. Also analyze it for the preceding 3 to 4 years. See whether there's a good jump in this ratio. If there is a good jump, that would reflect that the assessee has a higher fixed assets outlay and higher depreciation hit in the current year. Earlier, the depreciation adjustment or use of cash PLI has been accepted by the tribunal in a couple of circumstances, where the assessee had used higher rate of depreciation, accelerated depreciation, compared to comparables who were using the normal depreciation rate. One. Second, the depreciation to sales ratio of the assessee was higher. Either maybe it is because of a startup phase of the assessee, or it uses a higher depreciation rate. The Karnataka High Court in Novelis case has given the benefit of cash PLI, have said that depreciation can be excluded for the computation. And that could be one approach to look into the cases where the outlay on fixed assets due to the COVID has been substantial in IT infrastructure, laptops, etc. And that becomes a very big component in the financial statements. Those expenses possibly could be taken as non-operating in nature. Those expenses possibly could be taken as non-operating in nature. Taking loss-making companies as comparables. Now, what was happening is we were all using this persistent loss filter, where if the comparable is having loss for consecutive 3 years, then those were being excluded from the data set. Department has been using a filter of 2 out of 3 years. If it is having loss in 2 years, it excludes it from the data set. But possibly that approach may not be correct for COVID year, because COVID year is a disruption year where a lot of people will make losses because of the operations, except as I said, in certain industries, it might be favorable. So that filter may not be applicable in this year or COVID related period, and that may have to be, that could be excluded for calculating those could be included, persistent loss making companies could be included in the data set for calculating the margins. There is a concept called as term testing. That means, as I said, there's a gap. Currently, you will be using 1 year of the assessee and 3 years of the comparables. So there's a concept called as term testing. That means you use 3-year data of the assessee and 3-year data of the comparables, because you bring them on par. And this is prevalent, and even Singapore has accepted this kind of comparison. Singapore in the guidance has accepted this kind of comparison. But in the Indian context, rules does not recognize this. If this kind of a concept is used, then both the comparables and the assessees will be brought on par, and the comparison will be at par. But unfortunately, we do not have such a concept in India. So it may, though we may do it for TP study, but it is not going to help. It has at the higher level when the matter goes into the litigation. This is not going to be accepted by the tax authorities and appellate authorities. So term testing may not be an acceptable proposition from the legal point of view, unless we get a blessing for this from the board by way of circular or modification in the rules. For differences, one will have to make adjustment. Idle capacity, exchange losses, working capital, these adjustments will have to be done. Now, idle capacity, there are multiple approaches to do an adjustment. I believe this might have been discussed in earlier class, and these have been blessed by various tribunal decisions. Whole point is getting proper data for this. If you get proper data for this, then it is a very good way to approach it. Industry averages has been accepted in certain decisions. So therefore, if my capacity underutilization 40 and industry is 30, then there's a gap of 10%, and that could be adjusted. The fixed cost of the assessee could be adjusted for that. Some have used an approach of the fixed cost by sales as a ratio, and that getting that number onto the comparables to arrive at that particular figure. That also could be used as one of the ways, and it will have to be done when you are doing it. As I said, even if during the assessment, if the TPO takes current year data, given that he will also be using 2-year preceding data, then 3-year data, still the comparables will have 2 normal years and assessees will be 1 abnormal year. So to bring the comparison at par, this adjustment is something which is required, which needs to be done. what we have all discussed will all be of no use if it is not properly documented. So documentation becomes key for the transfer pricing thing. So the TP study should include the following as a part of documentation, and these are very important. One, a broad analysis of how industry has been affected by COVID-19 and direct impact of COVID-19 on the tested party. So three-level study. One, what is the impact at the country level? What is the impact at the industry in which the assessee is operating due to COVID? Third, what is the impact of the COVID-19 on the tested party, on the assessee? Needs to be analyzed. This three needs to be documented in the transfer pricing study report. That it will give a fair idea when during the course of assessment that what is the impact at all the three levels. You should also document the impact of COVID on the associated enterprise. So suppose my associated enterprise in a European country or a US country or certain other places, the impact will be different for different associated enterprise. So this is also one of the very relevant information which will have to be documented due to this. This should be asked to the assessees to give this information as a part of TP questionnaire to the assessees, and once we get this information, it should be documented as part of the TP study. Documenting changes, if any, in functional analysis and contractual terms. As I said that if you're changing the arrangement, if you're making changes in the agreement, if those changes are there, those should be documented as a part of the TP study. That this is what has been changed and these are the reasons for the change. All that will have to be brought into the TP study, that what is the reason for the change, what is the reason for the change, what is the change, and what is the reason for the change. If you select comparables and the COVID-19 related disclosure of the comparables, whether there are any disclosures, if not, how do you assume that there is no impact of COVID-19 on the comparables, or if there is an impact, what is the quantum of that impact? This should be considered from the disclosures what the auditors of the comparables would make in their financial statement. That should be documented as a part of the TP study. Then whatever adjustments you do, how the adjustment is done, what is the rationale of that adjustment, how the figures have been arrived at, all this will have to be documented as a part of the TP study. Another important aspect is the variance between budgeted and actual results. If the company has a process of having a budgeted results and doing a variance analysis, it would be a good feature to have this data available, that what is the variance between the budgeted and actual, and what was the reason for variance between budgeted and actual. That means the COVID has impacted, say, sales, because 45 days it was closed, I could not open my hotel, so there's a 45 days sales impact or something similar. So profitability, how it has been impacted from the budgeted to the actual, if this is documented, gives a fair view how it has been done. If you're documenting budgeted versus actual, you will also have to analyze whether in the preceding year the variance analysis whether was within the tolerable limit. If it was not within the tolerable limit in the preceding years, then in the subsequent years the sanctity of that budgeted figures will be doubtful. Then any government benefit that has been received by the company, any specific government schemes that has been helpful, those also could be documented vis-a-vis the comparables, whether any comparison is there. So these are the aspects which are arising due to COVID. As I said, there are various areas where the regulations today do not address, and hopefully government will require clarifications on various aspects. One is the data, which data to be used, when data to be used, current years, subsequent years, what would be the impact of the data that needs to be analyzed based on the data, what can be used, that has to be clarified. Multiple year of the data of the comparables, whether I can do single year comparison, going forward after 2 years down the line, whether the comparables still multi-year data should be used, because the earlier years will be impacted of the COVID when I do analysis in 22 or 23. So that aspect the government should look at it. So these are something which government should bring out on the transfer pricing clarities on these aspects. Then loss making should be permitted, and they should direct the field officers that at least in 1 or 2 of these years, the loss making should be permitted. Adjustments which we are doing for extraordinary items, extraordinary expenses, idle capacity, or other adjustments, these should be permitted. If the government increases the range, currently it is 3 years for the arithmetic mean if you adopt less than 6 comparables. If there's 6 or more comparables, we use interquartile range of 35 to 65%. If that range is enhanced, say 3% becomes 5%, at least for the COVID period, that would be big relief, because that range of 2% would give you leverage, because your profitability might be impacted by 1 or 2% in manufacturing segments or distribution segments. That range would take care of that difference. Even if a higher interquartile range is given of 25 to 75 or 85 to 15, 15 to 85, that would be very good, and it would send the right signal that government understands the difficulties which the companies are facing in transfer pricing arena, and they are trying to address that. Safe harbor rules, if they are prescribed at the earliest, that would again be helpful, and a reasonable safe harbor rule, if it is prescribed, that would help many companies in terms of closing their financials, and it would avoid a good amount of litigation on the transfer pricing front. So with this, I have tried to cover major issues arising to COVID. If there are any questions, I can take them and we can try to address those questions.
There is a question in Q&A. Can you see that? One question are connected 3 matters also, he explained that. You want me to read out?
No, I think this was
Already answered?
Answered by Vaishaka in the first session. I think same question stays there.
No. Okay. It is already
Yeah,
answered, fine.
Yeah,
No, it is
answered.
yeah, 526. Yeah, probably
Yeah,
Vaishaka must have answered.
Yeah.
Okay, otherwise no other questions. So yeah, we had a fabulous session today. You have even explained the detailed COVID impact and how it has to be addressed also. I think a fantastic session. Even Vaishaka must have handled it extremely good. And the last 2 days also, we had an excellent session. Definitely it is all our participants enriched from this 3 days workshop on transfer pricing. So thank you very much on behalf of Bangalore branch and on behalf of all the participants. Our wholehearted thanks to all the faculties who shared their precious time and valuable knowledge with us. Thank you very much. Over to Divya to propose a formal vote of thanks.
Thank you, sir. Dear members, I take this pleasure on behalf of Bangalore branch to propose formal vote of thanks for 3 days virtual CPE meet on transfer pricing. My wholehearted thanks to all the speakers of 3 days program. Shri Gyan Prakash Srivatsav, Advocate, Shri Rishi Harlalka, CA Ganesh Krishnamurthy, CA Faiza Fatima, CA Hiranmayi Ganesh, and today's speaker we have CA Vaishaka Bhatt and also CA Narendra Jain. Wholehearted thanks to all of you for spending your valuable time and enriching all of us with so much of knowledge. Thank you so much, all of you.
Thank you. Thank you very much.
Thank you all participants for your active participation. Request you to kindly look into Bangalore branch website for further programs from Monday and kindly support us. Thank you.
Thank you.
Thank you.
Good night. Bye.
Thank you. Good night, all of you.